Even though equities are very expensive, there's more liquidity in the system today than there was pre-pandemic.
This market is just pushing you into risk, and it's been really hard to resist that momentum.
You need to be risk off to be back to risk on.
It's looking pretty bullish right now. You still have to be careful.
The market will respond when the circumstances change, for the better or for the worse.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, Chair Powell isn't going anywhere fast.
For the time being, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance.
The Fed Chair Jay Powell remaining unmoved, sticking to script on Capitol Hill. Little sign it's hurting tech stocks, the Nasdaq breaking through all-time highs as equities keep climbing the wall of worry, filled with key self-imposed deadlines for taxes and for trade.
Yeah, yesterday was all about hope in this disinflation story and belief that we are going to see it. And this comes with the de-escalation in the Middle East. Yes, there are these potential risks out there, but a lot of people feel like we have priced them in. And given the fact that we haven't necessarily seen the huge inflationary shock to a lot of the recent data, it gives people the sense the Fed can cut without necessarily seeing the weakening in growth that a lot of people were worried about.
And now we're getting closer and closer to these two key deadlines. July 4th, the ambitious deadline for the tax bill. July 9th, the expiration of the global tariff pause. And I have to say, the tariff story is hardly being discussed in the notes that I've read so far.
Which is ironic, considering the fact that we're hearing about retaliation potential from Europe recently. If there is a sort of baseline 10% tariff that the U.S. probably will impose on them. So at what point does that rev back up? There is a feeling that as long as there are good faith discussions by some of the trading partners of the United States, that there will be a kicking the can down the road. Nonetheless, tariffs will be higher. How has that trickled through to expectations? And at what point are we just being a little bit sanguine to risks, considering that it's been very hard to trade on any of them?
Was that a better tone over in Europe at the NATO summit? The president getting a warm welcome from Marc, a friend of this program over the years who we've spoken to. I think we always knew that he was going to be a closer ally of this president, Donald Trump.
Warmer tone, I think, is putting it mildly. Talk about, well, we welcome somebody who is able to push us into doing what we knew was right all along, and this is the right path forward. I would say yes, with one exception, Spain. Spain seems to be the outlier to absolutely everything, and I find it really interesting to see how they're saying, look, we don't think this is a good policy for us, so no, we're not going to spend 5% of our budget and carve us out. And otherwise, there was this feeling of, we agree with you, Russia, China, both existential threats. We need to be building up our military force. And thank you for spurring us to action.
We'll get to Annmarie in just a moment on that story. Equity futures so far coming off some decent gains. The S&P 500 just about unchanged. Coming up this hour, Jay Pelosky of TPW Advisory with the Nasdaq back at all-time highs. The former Deputy National Security Advisor Victoria Coates on today's NATO summit. And Greg Daco of EY on Fed Chair Jay Powell's second day on Capitol Hill. We begin this hour with our top story. Reports questioning the damage done to key Iranian nuclear facilities. The president pushing back.
Mr. President, what's your reaction to the intelligence reports saying that the Iranian nuclear sites were only partially devastated?
They don't know. I mean, they did a report. We hear it was obliteration. It was a virtual obliteration. When you take a look at the ground above, don't forget, the flame is all underground. But everything above, if you look at the before and the after picture, everything above is burned black.
Joining us now is Annmarie from the NATO summit. AMH, some strong pushback from the president and his team.
Absolutely. The president and his team are really disregarding this leaked report in both the New York Times and CNN and a number of other outlets. This comes from the Defense Intelligence Agency. It's part of the DOD. And what it goes into is that some of these core components of Iran's nuclear program, they say, wasn't hit to the extent that they feel that the president was talking about when he talks about obliteration. And they're saying basically that now Iran's nuclear program is set back just months. What I would say is you have to look at some of the other data we are seeing and voices we are hearing in this debate. I would go to the IAEA's Rafael Grossi, who was on our program last week. He said that it's been significantly damaged in terms of Iran's capabilities. He says there is a question now whether it's months or years if Iran was going to rebuild. And he says we just don't have enough data. He needs to get his inspectors on the ground. I think that's a constructive view to take. DIA is just one of more than a dozen intelligence agencies. This is preliminary. In the intelligence world, what the Defense Secretary Pete Hegseth will tell you is that preliminary means it's low confidence at this moment. So the president's team is pushing back because they want to get more information, and it's just too early for some of this sensitive data collection to really understand the extent and the damage that was degraded in terms of Iran's nuclear capabilities.
This was certainly a dominant part of the conversation earlier on this morning. Just a secondary story is the alliance itself. Annmarie, is this alliance where the president wants it to be?
It looks like it is. I mean, if you just go off vibes right now, his discussion with Marc Rutte, he said, we started this together years ago. We've been working on this. It does seem like the president is walking into this NATO summit very different than some summits I've covered during the president's first term, with a lot of optimism that they're going to get to the finish line that this administration would like to see, even if you have some potential spoilers like Spain who do not think they need to hit that 5% target. That 5% target, though, we should note, is going to be over a very long period of time. And it's not just hardcore defense spending when it comes to things like armor and weaponry and tanks and what you think of when you think of a defense industrial complex. It's going to be split 3.5% for hardcore defense, then 1.5% on some of the industries that support it. Maybe in the United Kingdom, they're going to use some of that for, say, border patrol. You can use that for some countries when it comes to cybersecurity, some infrastructure that might be needed to support their defense complex. So that is a way that some of these countries are going to be able to meet that target. But that target certainly is important for the president. You had Marco Rubio, Secretary of State, speaking to Politico before the summit kicked off today, and he says this NATO meeting is Trump's summit.
AMH, thank you. Appreciate the update. More from Annmarie later this morning, and more from the president as well. Expecting a news conference at 9 a.m. Eastern time, so a few hours from now. Here on Wall Street, here's the big view at the moment. Pelosky of TPW writing the following: one should employ the stoic strategy to investing in the age of Trump. It is an investing superpower to ignore what Trump says and focus on what he does. Jay joins us now for more. Jay, good morning, sir. Help us focus on what's important here. We've had a rally off the low of, I think, around 30% on the NASDAQ 100. And some people who didn't participate just scratching their head and asking why. How did this happen?
Well, John, great to be with you and Lisa. And look, it's all about earnings in this case, right? Earnings have been good, have been better than expected in Q1. We're coming up on earnings season going forward. And as long as earnings are okay, the market can ignore a lot of the bad news. But in our view, what's really been important over the last week is the confirmation of some key signals about the new dynamics playing in the global cross-asset markets. And we look at the Israel attack on Iran and then the U.S. attack on Iran and note three things. First, Bitcoin didn't rally, so really reinforcing its view as a liquidity proxy. Second, the dollar didn't rally, which is really very interesting, even though it was on a 3-year low. And third, and perhaps most importantly, the U.S. Treasury market really hasn't rallied. It's improved about a dozen basis points over the last week, but pretty de minimis. And that to us really suggests the key point, which is that the rest of the world has over-allocated to the U.S. and has no more need of U.S. assets, even in a Middle Eastern crisis, which is quite unusual versus the last 20 years of history or so. And so for us, that really reinforces our main point, which is we are in the beginning of a secular leadership change away from the U.S. to the rest of the world, underpinned by a sustained period of capital repatriation out of the U.S. back to the rest of the world. And look, you talk about NASDAQ. Sure, NASDAQ has finally caught up to a new all-time high. That's great. Chinese tech is outperforming NASDAQ year to date by about a ratio of 4-to-1.
Jay, when was the last time that you were less overweight or more underweight the United States assets and U.S. assets more broadly than you are right now?
That's a good question, Lisa. It's been quite a period of time. We have been overweight non-U.S. assets. You know that. We've talked about that on the show, for probably a year or more. We've been bullish on China for the last year now, year and a half. John, you and I talked about European banks. Again, an example, European banks are up 30% year to date. XLF, U.S. banks are up about 5%. So the game has been offshore. We think that's going to continue. We think we're in inning one. But the real interesting thing now for us is the focus on a weak dollar and what that means for emerging markets, namely the ability to cut rates to support their growth cycles, which is, again, historically not the case. Usually you have crises, dollar rallies, EM can't cut rates because it's afraid of what will do to the currency when a strong dollar. In this environment, very different. So we think global growth is in a long cycle, and we think the real opportunity set up here for the second half of this year going into 2026 is emerging market debt and equity and commodities. We think commodities are really interesting across the cycle, across the spectrum right now.
Jay, there's a real question here, especially as we head into a couple of key deadlines, July 4th and July 9th, whether we're being overly complacent about particularly trade. John was making the point earlier, why is no one talking about tariffs at a time when we potentially have a lot of disagreements coming up? Are we underestimating the risk that we are not adequately pricing that in, not only to U.S. assets, but globally to areas that are going to get hit pretty hard if some of these tariffs go on?
No. Short answer, no. Tariffs have already been discounted by the market. What moves the market is uncertainty, and tariffs are certainty at this point. We know that. So the market's already priced it in. Corporates have close to record margins. If you have a 10%, 15% tariff on things, that's digestible, unlikely to be much more. The government, the U.S., is kind of handcuffed in what it can do because it can't really afford inflation. And inflation pushes up rates, higher rates blows out the deficit even more and creates a problem. What we're focused on is not tariffs, not the Fed. It's all about the fiscal space. Who has the space to grow, to spend on AI, climate, and defense? Just talked about defense in Europe. That's a prime driver for European growth, for German growth. And that's what's driving the markets, the recognition that U.S. upside is capped in terms of no fiscal space, capped in terms of higher interest rates, capped in terms of weak dollar, premium valuation, center of uncertainty. And the rest of the world doesn't have any of that. So that's really, that's really the opportunity, not tariffs. Tariffs, not spending any time at all thinking about tariffs.
Well, Jay, let's finish on the commodity story. So you mentioned that weak dollar, euro dollar back to about 116. When you talk about commodities and maybe fold in that FX story, which commodities are you thinking about? Is it the precious metals or is it something beyond that?
Yeah, John, really for us, it's a global growth long cycle with a weak dollar. Commodities are the play on global growth, play on a weak dollar, play on emerging markets able to support their economies. It's commodities look to us and others, technicians, to be breaking out, broadly speaking, the Goldman Sachs Commodity Index, breaking out relative to itself and its own history, breaking out versus the S&P. And so that's important, right? So you have a fundamental case, a technical case, and assets that completely underallocated to. Commodities have underperformed stocks for years and years. So we like the whole complex. So we're exposed to precious metals, precious metal miners, copper miners, agriculture, energy, really the entire space. And when we look at our portfolio, our model portfolio over the last month or so, commodities are right up there. 3 of the 5 best performers are in the commodity space. And even oil. Sure, oil pulled back given the what's going on in the Middle East, the truce, et cetera. But it's held up very, very well given all the supply that is supposedly coming on from OPEC Plus and others. So if we're right on global growth, we're right on emerging markets being able to support their growth cycle, then energy should do fine. So we see the whole space as an area of opportunity. And just as an example, we have been, to be frank, close to double weighted commodities versus the benchmark that we track ourselves with.
Hey, Jay, always appreciate the update. Thank you, sir. It's good to see you again. Jay Pelosky there of TPW Advisory. I have to say, crude is a trade for the brave, at least over the past few days. But the overall framework for Jay at the moment is Germany's got the space to stimulate, weak dollar story, strong euro, and play commodities because we're going to see a global economy rebound, and he's not even thinking about tariffs.
Yeah, he said markets have priced it in. And I'm thinking, what is it? Is it no retaliation? Is it a baseline 10% tariff? And then it starts raising this question, does it mean that people are writing off the possibility of any kind of re-escalation of trade concerns? Is there a sense that President Trump always de-escalates and that will be the ostensible outcome at a time when I'm old enough to remember April 2nd, when that roiled markets in a profound way and caused a lot of institutional investors who are long-standing practitioners to say this undermines a lot of their baseline expectations. So I don't know. I think that's a very interesting take.
Not even 3 months ago. Equity futures right now. Unreal, isn't it? Equity futures on the S&P just about unchanged. Let's give you an update on stories elsewhere this morning, particularly an update here in New York City with your Bloomberg brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. We start with a major surprise, as you said. Sohran Mamdani is poised to win the Democratic nomination for New York City's mayoral race. This after a commanding win in the first round of voting. The New York State Assemblyman is running on a progressive platform amplified by social media and policies like vowing to freeze rents and making buses free. Former New York Governor Andrew Cuomo has conceded to his upstart rival. And we turn to another shocker. President Donald Trump surprising oil traders and even his own officials yesterday when he announced that China can continue to purchase oil from Iran, a move that potentially undermines years of U.S. sanctions on Tehran aimed at cutting the regime's main source of revenue by making its top export off limits. And a check on shares of FedEx. They are falling 5.7% in the pre-market after the delivery company forecast weaker than expected profit for the current quarter. And although it typically provides a full year forecast, FedEx said it would only share its outlook for the current quarter due to the uncertain global demand environment. That's your Bloomberg brief. John?
Yahara, thank you. Did China ever stop buying Iranian crude? Amrita Sen's going to join us in about 15 minutes to have that conversation. Up next on the program, virtual obliteration.
Mr. President, what's your reaction to the intelligence reports saying that the Iranian nuclear sites were only partially devastated?
We hear it was obliteration. It was a virtual obliteration.
Up next on the program, the former Trump Deputy National Security Advisor, Victoria Coates. From New York City this morning, good morning. The volatility over the past few months has been absolutely phenomenal. The Nasdaq 100 is back at all-time highs, record highs, for the first time since February. But just think about where we've been. A 30% rally off the April 8 low after a 20% plus decline off the previous high. This morning, equity futures just about unchanged on the Nasdaq 100. On the S&P 500, we're going absolutely nowhere. Under surveillance this morning, virtual obliteration.
Mr. President, what's your reaction to the intelligence reports saying that the Iranian nuclear sites were only partially devastated?
They don't know. I mean, they did a report. We hear it was obliteration. It was a virtual obliteration. When you take a look at the ground above, don't forget, the flame is all underground. But everything above, if you look at the before and the after picture, everything above is burned black.
Here's the latest this morning. President Trump pushing back on New York Times reporting that his airstrikes against Iran had limited impact on its nuclear program. Trump posting on Truth Social overnight the nuclear sites in Iran are completely destroyed. To discuss, the former Trump Deputy National Security Advisor, Victoria Coates, joins us now for more. Victoria, welcome to the programme. It's good to get your input on this and your experience. For people not familiar with it, could you share with us how long typically it takes to get the kind of battle damage assessment in our hands that we would actually have a high degree of confidence in?
Well, good morning, John. Good to be with you. This can take weeks, if not months, to get a full accounting of what happened. Because bear in mind, the Iranians are not sharing information freely with the rest of the world on what was done to them last Saturday night. And furthermore, as the president said, these sites are underground. So it's not something you can just look at from above. So we're going to be doing a lot of different things to try to gather this information, including watching what the Iranians do. And this is the critical thing. Even if the damage was less than we had hoped. And I don't think it is. I really think we should take our information from the chairman of the Joint Chiefs of Staff, maybe not the New York Times. And Chairman Kaine said he thinks the damage was quite significant. But even if it wasn't, what was demonstrated by the president's action and Israeli actions is we can go back any time. The Iranians can't defend themselves from us. And so if there wasn't sufficient damage done in the first run, we can take another shot at it.
Victoria, there is some speculation that that type of threat is going to force any kind of nuclear program, an enrichment program underground into secret locations that are out of sight. And I wonder how crucial or how much of a part of some of the negotiations of the ceasefire that President Trump orchestrated between Iran and Israel included ongoing oversight not only by the IAEA, but by U.S. nuclear specialists.
Well, Lisa, I think that's a conversation to come. I mean, the ceasefire was very much about the immediate military hostilities, primarily between Israel and Iran, coming to a close. But these are the discussions we have to have. And that's why the leverage that the president has gained over the last couple of weeks and Israel has gained over the last couple of weeks is so critical. If we were having this conversation 2 Wednesdays ago, I mean, you almost would say, gee, you know, the Iranians have the upper hand here. Now they are completely exposed, completely vulnerable. They're going to need to make concessions to get back to the table rather than the other way around. So the conversations about how they are going to constitute any civil nuclear program they may wish to have going forward are going to be a lot tougher on them than they would have been.
With all due respect, I mean, one of the arguments has been that if they just preserve their regime, they are able to continue with some of their goals, including the enrichment of uranium, without the oversight. Are you saying that this isn't an imminent concern, that this isn't something that you foresee being an issue for the next number of months, and that's something that they can get to later, not now?
Well, no, if I understand your question correctly, I mean, this issue of how we're going to structure oversight of the Iranian nuclear program was not something that was dealt with in the ceasefire. And it wouldn't have been. That was a military arrangement. That is something that is a technical negotiation I assume will be overseen by Steve Witkoff and his team going forward. But the president is in a much stronger position now to enforce his red lines of no enrichment. Witkoff reinforced that last night in an interview as a bottom line for the administration, that they were not going to give it all on enrichment, and they don't have to now. So I think that is the discussion that will come up. As to regime survival, you know, that's really up to the Iranian people, rather. That was not the mission of the American administration in here to change the Iranian regime. I mean, I have my views on them. I wouldn't be sad if the Iranian people made that decision. But at the same time, the point of this exercise was to degrade the nuclear program. And in my opinion, that was achieved.
The president is certainly in a strong position at this NATO summit. In the meantime, China has been very quiet. Russia has also been quiet. How do you think about the consequences beyond Iran of the strikes over the weekend?
Yes, the collusion between China, Russia, Iran, and North Korea that took place during the Biden administration was one of the big strategic kind of changes that the incoming Trump administration had to deal with. We didn't look at it that way during the first term. So that has been a major problem, and China gaining strength from those kind of, you call them vassal states. That's hard to call them allies. And the weakness in that relationship has been really exposed because China really doesn't have the capacity to do the kind of force projection that the United States demonstrated Saturday night. That's really ours alone. Neither does Russia. And Russia's also lost their bases in Syria. So their ability to help Iran is fairly limited, and they don't seem eager to do what they might even be able to do. And on top of that, you have this extremely strong NATO summit this week for President Trump, a real show of unity in the transatlantic alliance, which he was supposed to be destroying, but instead has made stronger than it's been in decades. So I think this is a very powerful moment for the president, a very strong message to both China and Russia that the United States is much stronger than we have been.
It's well framed. Victoria, it's good to get your thoughts as always. Victoria Coates there, the former Trump Deputy National Security Advisor. Worth reflecting on where we were in the president's first term when he went to these NATO summits and told them they had to do more. When he was laughed out the room at various places for criticising countries like Germany. And then to see that image of it sitting there with Marc Rutte, the former Dutch Prime Minister, now NATO Secretary General, essentially telling him, you were right and we're changing.
And with all of the members saying we're changing because of existential threats, because you were right, not necessarily because you are forcing us to do so.
Up next on the program, Amrita Sen of Energy Aspects as President Trump says China can buy Iranian crude. Coming into Wednesday, our record highs on the S&P 500 this morning. Equity futures just about unchanged. On the Nasdaq 100, we're positive by 0.1%. 3 hours away from the opening bell. Let's get you some morning movers with Danny Berger. Hey, Danny.
Hey, John. One of the biggest gainers in the pre-market this morning is Stellantis, getting an upgrade from Jefferies. Jefferies saying that this company is starting the process of turning around when it comes to Europe and the U.S., North America. It's doing a good job refreshing its lineup, renewing that and helping with some of their stocking issues. Also saying the new CEO has had plenty of time to come up with a viable plan and hit the ground running as he takes the helm. So those shares up 3 3/4%. To the downside this morning, there is QXO. This is a building supplies company. They're hoping to raise $2 billion via a share sale, a dilutive event. Therefore, you see shares declining nearly 6%. It's raising that money in part should it want to fund a takeover bid. Currently bidding for GMS, another building supplies maker, but Home Depot also reportedly in the market for that one too, so might get something of a bidding war. Finally, wrapping things up with FedEx, who had earnings after the bell yesterday. A tough set of results when it came to its forecast for this current quarter. The profit missed estimates. It also usually gives a yearly forecast. It declined to do so this time. The CEO citing the uncertain environment and the U.S. and China shipments that deteriorated sharply. It is their most profitable route. And of course, given the tariffs, given the uncertainty around that has fallen off of a cliff. So shares down over 5.5%, John.
Danny, great work. As always, more from Danny in the next hour. On our radar this morning, our top story, President Donald Trump pushing back on reports the U.S. strikes on Iran likely only set the nuclear program back a couple of months, saying they are, quote, completely destroyed.
And the president's team pushing back harshly on that, saying, according to them, things have been more obliterated than that, or virtually obliterated. Victoria Coates was just on talking about how she does actually think that this did set the program back significantly. The big question now, and this really is the focus of markets and of strategists, how much did this actually thwart their efforts? And frankly, how much can it get them back to the negotiating table to get some oversight in a consistent way as we try to figure out a path forward?
I think we have to stress, and you mentioned Victoria, she did a great job of this. It takes time, weeks, maybe even longer, to have a full battle damage assessment in your hands that you can have a high degree of confidence in. And the Pentagon report that a lot of media outlets are citing is an initial assessment which the Pentagon itself wouldn't have a high degree of confidence in. And that's something that we should highlight this morning. It's not the president versus the Pentagon. It's an initial assessment, and it's going to take time to have something much deeper, more thoughtful, much clearer about what's happened here.
And these are details on our larger objective, which we've heard from both the president, the IAEA, which is how to create some sort of new oversight regime. There also is a question, even if there is disagreement over how much damage was actually inflicted on this program, what this does diplomatically heading into NATO and what this does in terms of a sort of deterrence around the world. Doesn't abnegate that. I really do still think this shows that the focus very much is on what kind of oversight there is on this nuclear enrichment program.
Yeah, what's super concerning for me and for you too, and I think for Annmarie as well, we don't know where the highly enriched uranium is, and no one seems to know.
There's 400 kilograms or 880 pounds of highly enriched uranium at 60%. It doesn't take very much to get it to 90%. There is concern about centrifuges that have been outside of the reach or the oversight of the IAEA, and this is what's got a lot of people concerned. Could there be dirty bombs? Could there be some other type of weapon that gets created, and how do you prevent that from happening?
AMH at the NATO summit this morning. We'll catch up with her again in about 40 minutes from now. Need to turn to the domestic agenda here in the United States. Treasury Secretary Scott Bessent saying House and Senate Republicans will reach a SALT deal over the next 2 days, saying he thinks senators can begin the multi-day voting process on the package by Friday.
Yeah, with pressure from President Trump telling senators in a Truth Social post today or overnight, lock yourself in a room if you must. Don't go home and get the deal done this week. How much is this deal sort of the first step before some of the tariffs get negotiated? And this is sort of the 1-2 punch. How important is it to get that July 4th vote before you can even begin to solidify what gets agreed on or not with the tariff discussion? And I think that that's sort of the sequencing that they're trying to get out there.
I couldn't agree more. The interplay between those two deadlines is very interesting, even though they are self-imposed deadlines. Some news here in New York City. Zohran Mamdani delivering a stunning political upset. The 33-year-old Democratic Socialist is the presumptive winner of the Democratic primary for mayor of New York City. The election is set to take place on November 4th.
So there's a lot to say here. I will go very narrow to say that this highlights the fight for the soul of the Democratic Party in terms of the more centrist versus the more progressive, more socialist type of wing. It also highlights the social media presence and how much that has changed the narrative in a significant way and how different candidates game the ranking system. A lot of people thought that the ranking system would actually make the primaries more fair or more sort of accurate in terms of reflecting people's will. And what Mamdani did was he entered into partnerships or pacts with other candidates to try to get some sort of ranking that was beneficial to him. Look, it changed. There is a change strategy right now with social media and with some of the new voting rubrics.
What's the cheat guide for not offering your opinion? Just cite someone else, right? I'll cite Garry Kasparov. Socialism is like polio. It comes back when people forget about the horrible damage it did last time. His opinion, of course, and
of course.
Not mine. Let's turn to crude. President Trump surprising traders by posting on Truth Social that China can continue purchasing oil from Iran. Brent crude coming off the biggest two-day decline since 2022. Amrita Sen of Energy Aspects joins us now for more. Amrita, I want to get to this line that's coming from the president. Can you help me answer this? When did China stop buying Iranian crude?
I think that's a question you might have to ask him, but basically there's been a lot of confusion since that statement that, to your point, China hasn't stopped buying Iranian crude. China is still buying 1.5 to 1.7 million barrels per day of Iranian crude. There was maximum pressure under the first Trump administration, which did get exports down to 400,000. But then since the Biden administration took office, it's been kind of creeping up, and then election and high oil prices were an issue. So the administration turned a blind eye. So yesterday, when the kind of tweet came out, everybody was like, okay, does this mean sanctions are being lifted? Anyway, the point being, since then, the White House has clarified this is not a change in sanctions policy. However, we would also say this does mean that there's not going to be a tightening in sanctions either, i.e. status quo prevails. China continues to buy about 1.5 to 1.7 million barrels per day of Iranian oil.
Just build on some of those numbers, Amrita. What is that of a share of total Iranian production? The amount of barrels that are on the market right now already?
So Iranian production is about 3.5-ish million barrels per day, oscillates a bit between 3.5, 3.7. All their exports, whatever they are exporting, goes to China, and the rest of it is consumed domestically.
Which is the reason why this is such a big potential buyer and why this is such a big deal for the oil markets in terms of who else would supply that and what this would mean for the price. Does this suggest that this is part of the ongoing negotiation, that the goal is to keep oil prices low, and to bet against that is frankly a fool's errand?
I would say that's exactly how the market's interpreting it. You know, when we are talking to our clients, the general impression is that, look, we know President Trump wants low oil prices. He's going to get it one way or the other, right? So if that means that, especially because we were in the high 70s not that long ago, that means that we're not going to see tightening of sanctions. And I think traders are very much focused on that, the fact that he wants low oil prices, especially ahead of the bill. And he has been saying that consistently, right, that he doesn't want prices to go up. Inflation is a big concern. So that's where I think the market kind of that's why the market reacted the way it did in terms of selling it so hard. But at least since then, it's been clarification that sanctions are still in place. This is China avoiding sanctions and the U.S. not doing anything about it. But yes, it does mean that there's more oil in the market than otherwise would be.
But from a trading perspective, Amrita, doesn't this act as a cautionary tale to anyone who tries to expect oil prices to rally in any kind of material way? That there is a Trump put, in essence, on that there is a willingness to navigate the geopolitical situation in a way that brings down oil prices one way or another. So why would you bet on $100 crude or $90 a crude, which is the worst case scenario that so many people are talking about?
Yeah, no, I completely agree. And I've been surprised that people have been calling for that. I've been with you guys saying that, in 70 and 80 is not going to be sustainable given where the balances are. And, people are looking towards those bills that we are also predicting from Q4 onwards. I think the challenge, of course, is that this is not a market you can short either, because these risks and the geopolitical risks are real. Fundamentally, though, the right here, right now remains very, very tight. Stocks are very tight. Cushing, just look at that. It's super low. So this is also equally hard to short. But on a macro level, your point is very valid that Trump and his policies will somehow make sure that prices don't run away too quickly. It does mean that generally there's a bias towards the lower side.
Amrita, can we just finish up by asking you what the demand side looks like at the moment? I think economists are really scratching their heads at the moment about where the economy is, particularly here in the United States. We're trying to gauge where we are, speaking to company executives. What's your take, just looking through the prism of crude oil?
Yeah, it's not great, but it's not dire either. And I think we're kind of in between. Our demand number is between 700,000 to 800,000 barrels per day growth year on year. Again, the US is actually doing okay. Europe is doing very well. China, not so much. And I think that's kind of the spectrum. We don't think this is a recessionary environment in the sense of what people were expecting when tariff fears were at its peak. But it's also not an environment where global growth is humming along very nicely.
Amrita Sen of Energy Aspects. Amrita, thank you for the update and the clarity there on the Iranian crude that's already going to China and what difference it will make if they just permit it this time.
Well, if they just permit it this time, first of all, it is possibly a loosening up in sanctions. But to your point, it just means that constraint on oil supplies, that some of the offset from Iranian supplies that would be taken back if there were sanctions put on, that won't have to be made up. So you can continue with everything status quo.
Javier Blas was talking about this earlier on this morning. These are sanctions that just haven't been enforced for a long, long time. This Iranian crude, these barrels have been on the market now for years and years.
Yeah, so how much of a negotiating chip is this? And how much did this actually participate in the discussions that they had to negotiate a ceasefire? The idea of people not knowing about it, do they have to know? Or is this just basically the de facto policy as has been written?
What a round trip we've seen on crude oil, Brent and WTI over the past few days. That's the situation with commodities. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. We start with some other China news. Officials there are confident they can build the consumer sector into a key engine of the economy. Chinese Premier Li Qiang says China is positioned to have its economy evolve into a mega-sized consumer powerhouse on top of its strength as a manufacturing giant. For now, the reality is China's economy continues to struggle with a weak consumer. Meanwhile, the U.S. and Mexico are negotiating a quota system to reduce tariffs on some steel imports. The proposed quota would be limited to a certain volume of imports and would exempt that amount from the 50% tariff. However, steel would still be subject to a 10% baseline charge. And Hims & Hers is standing firm after Novo Nordisk abruptly ended its distribution partnership over what it called deceptive marketing. In his first interview since the breakup, Hims CEO Andrew Dedham says they won't back down from offering cheap weight loss shots. Shares are up about 0.7%, but they had their worst single-day drop earlier this week on news of the breakup. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in the next hour. Up next on the programme, well-positioned to wait.
For the time being, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance.
Up next on the programme, we'll get the thoughts of Greg Daco of EY, and we'll catch up with Mike McKee, who sat through the whole thing yesterday and will do exactly the same thing again today, so you don't have to. Live from New York, this is Bloomberg. Equity futures right now in the S&P very close to all-time highs, at record highs on the Nasdaq 100 this morning. Equity futures just about unchanged and positive 0.1% on the Nasdaq at the moment. Under surveillance this morning, well positioned to wait.
Policy changes continue to evolve and their effects on the economy remain uncertain. The effects of tariffs will depend, among other things, on their ultimate level. Increases in tariffs this year are likely to push up prices and weigh on economic activity. For the time being, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance.
It's the latest this morning. Fed Chair Jay Powell back on Capitol Hill today after reiterating his wait-and-see stance just yesterday. Powell emphasising that many paths are possible. Bloomberg's Mike McKee joins us now for more. Good morning, Mike. You sat through it all. What were the highlights?
Well, I'm not sure there were highlights, John. It was mostly the same show that we have seen for a while from Jay Powell. I saw the dress rehearsal at the press conference last week, and he took the same lyrics to Broadway yesterday. The Fed's argument is we don't have enough information yet, so we're going to sit and wait. And we will cut rates at some point, but it has to be when the data tell us it is a good idea. That has kind of clashed with what the president's view is. And the White House was looking for somebody, according to Mr. Trump's tweets, to take down the numbskull yesterday, but nobody really did. Everybody was pretty polite, although there were questions about the new sort of predictions from Chris Waller and Mickey Bowman suggesting that maybe they could cut rates in July. That didn't go over well with the rest of the Fed, it seems, because we heard from a lot of Fed officials, including Mr. Powell yesterday, who said that's not going to happen, basically, because we're not there yet. We heard from Powell, Williams, Barr, Goolsbee, and Schmidt, Bostic, Hammock, Daly, and Kashkari. They've all spoken since the Fed meeting, and they've all said, we need more information. And that's what the basic takeaway should be from this, is the Fed has not changed its position. It is going to be waiting. July is a very long shot, maybe September, and we don't know what's going to happen because we got a lot of news on tariffs to come yet.
Mike McKee, looking forward to day two. You are, I'm sure. Mike McKee, thank you, sir. If the president wanted a grilling just yesterday, I think you realised you weren't going to get it when they started asking questions about what is demand and what is supply.
They were actually sticking to the economic backdrop. I will say, though, that you did see a huge surge in the expectation for a September rate cut after that testimony. So there was definitely something that made people feel dovish.
The door is ajar, apparently. Greg Daco of EY writing this. A July rate cut is in play, but the odds are low. September is more plausible given expected labour market erosion and tariff-driven demand destruction. Greg joins us now for more. Greg, good morning. Good to see you.
How are you?
If April 2nd didn't happen, would they be cutting interest rates already?
Oh, yeah. I think that was the main element in the testimony. It was that Fed Chair Powell mentioned that had there not been the tariff and the tariff-related uncertainty, the Fed would have continued on its cutting cycle. And that's really a reflection of where monetary policy stands right now. Fed Chair Powell has noted on a number of occasions that monetary policy is slightly restrictive. They probably want to get closer to neutral, given what we're seeing in terms of the slowdown in labor market momentum and the gradual erosion of final demand. In that type of environment, they don't want to maintain excessively restrictive monetary policy.
Based on that, it sounds like they're tariff dependent. So how dependent are they on July 9th and the outcome of the trade negotiations?
I think we're all dependent on July 9th and then August 10th, which is the date at which the 90-day suspension of the reduction in the China tariffs comes to an end as well. So those two dates are going to be critical dates over the course of the summer, because should there be a re-augmentation of these tariffs back to levels that we experienced in early April, then we're likely to see a much faster set of shocks, essentially, that lead to demand erosion, a slowdown in the labor market that's faster than what we're experiencing, and then the recession odds start to increase. And let's not forget, there's another date in play. We have this self-imposed July 4th date for a tax bill to be passed. That is, again, another deadline that we have to pay attention to, and this interplay between tariffs and taxes is going to be essential over the summer in driving the economy going forward.
There's been a perennial question. When do we have enough data to be actually forward-looking and not backward-looking? I mean, this continues to be a conversation not just about the level of tariffs, but what companies and consumers do with them.
Well, the thing is that the Fed has been excessively data-dependent, in our opinion. We've seen that for the past 18 months, essentially, the Fed has been only relying on economic data. In this environment where there's tremendous policy uncertainty when it comes to trade, when it comes to taxes, when it comes to immigration and regulation, the Fed has essentially hidden behind the data and said, we're going to wait to see more data until we make a decision. It serves them well in this environment, but they also have to be a little bit more forward-looking. In my opinion, there is a window for the Fed to be easing, given that second-round effects from the inflation side of the picture are not likely to materialize in a weaker labor market. And what I mean by that is that for businesses that are facing these higher costs of goods sold, they're not necessarily going to allow for higher wage growth, and therefore there isn't going to be more persistence in terms of inflation. This is in line with the Waller argument.
This is reason why a number of notes after Powell's testimony said this just dials up the attention that much more to the unemployment rate.
Yes.
Not necessarily the headline numbers, but the unemployment rate more than inflation, because ultimately that will determine how sticky any tariff-related inflation could be. Do you agree with that? What is that sort of tipping point that would put July back on the table for the Fed?
The labor market in general is very important. I would be very cautious with just focusing on the unemployment rate, because the unemployment rate is a fraction. It's the number of people that are looking for a job relative to the overall labor force participation. And we know that labor force participation is under tremendous pressure because of reduced immigration. So the unemployment rate may not be proportional. The increase in the unemployment rate may not be proportional to the slowdown in economic activity and the slowdown in labor market momentum, because both labor supply and labor demand are being affected. So I'd be very cautious just focusing on the unemployment rate. I would focus on the hiring rate, which has been at a decade low. I would focus on initial claims for unemployment, which are currently rising. I would focus on job cut announcements that are up 50% relative to last year. Those are all better gauges as to the dynamics in terms of the labor market and where it's likely to head over the course of the next few months.
How instructive was the so-called labor differential in the consumer confidence numbers yesterday?
It's another measure of where consumers feel the labor market is headed. And why that is important is because we're not just focusing on what businesses are doing, but also what consumers are likely to do. And consumers have been excessively pessimistic about the outlook for the past 3 years, essentially. That's not been in line with how the economy has been doing and how they've been spending. What we're now seeing is increasing concerns about income trends and about labor market developments. And we know those are the key pillars to consumer spending activity. So I tend to put more weight on these indicators, these gauges of how people are expecting the labor market to evolve and income trends to evolve, because that will directly affect how they spend.
This begs the question then, if the potential for second round inflation effects are low, even if the uncertainty around tariffs is high, why don't you reduce interest rates anyway?
I've been arguing for the Fed to actually proceed with rate cuts because the economy is softening, and because if you want monetary policy to be forward-looking and anticipate any potential slowdown in economic activity, then you should actually be considering further easing monetary policy. Let's not forget, if you look at the real Fed funds rate, it's currently around 2%. If you compare that with other economies around the world, they're either back down to 0% when it comes to real policy interest rates, or they're actually below that. The Fed is alone, along with the Bank of England, with a slightly restrictive monetary policy stance. And I think there is room to accommodate without necessarily risking inflation expectations becoming unanchored, as has been the key risk that the Fed and Fed Chair Powell have been highlighting over the course of the last few weeks.
Greg, super sharp analysis as always. Greg Daco there of EY. Lisa, to your point, this is Governor Waller's argument at the moment, his and others.
And you pointed to the Conference Board survey yesterday, and I think we really have to highlight that. The number of consumers, the share of consumers who said that jobs are plentiful in this survey dropped to below 30%, and that is the lowest going back 4 years. It raises a question: how are we measuring a labor market that's highly in flux, with a number of people exiting stage left, whether it's immigration or whether it's retirements, and it's an increasingly difficult thing to do.
What did the Treasury Secretary call this? Tariff derangement syndrome. Isn't that what he called it? Is that Neil Dutta's line?
I don't remember exactly who coined that. I will give some sort of credit when I look it up. But there is this question here about whether it's political or whether they're conditioned by their experience of the past of getting inflation wrong. And that, I think, is what a lot of people are discussing. At the same time, how long are they going to wait before they have to pull the trigger?
The scars of 21-22 run deep, without a doubt, Bramo, without a doubt. Looking ahead to claims tomorrow, we're looking for jobless claims of 243. That's the estimate in our survey at the moment. The previous week, 245. Up next on the programme, Stephen Auth of Federated, John Lieber of Eurasia Group, the former Chief of Staff to Vice President Mike Pence, Marc, and Tina Adatia of Goldman Sachs Asset Management. Live from New York, the second hour of Bloomberg Surveillance. Up next.
only way you can end Iran's nuclear program is through a deal.
Tells the world that the United States is pushing for diplomacy.
Peace comes through strength, and that's been demonstrated by President Trump.
Does not want to get involved in wars.
If they don't come to the negotiating table, they're going to continue to see their regime and their capabilities weakened.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
So hot, I keep forgetting what day it is. Wednesday. Keep checking. I've checked 3 times already in the last 60 minutes.
Oh, I'm telling you, it's frying my brain too.
Wednesday. Coming into Wednesday, within 1% of all-time highs on the S&P 500, at record highs. On the Nasdaq 100, your scores look like this morning, totally unchanged on both the S&P and on the Nasdaq. Day 1 on Capitol Hill for the Fed chair yesterday. Day 2 later on this morning, this time in front of the Senate Banking Committee. Look out for that at 10 a.m. Eastern Time. Look out for this as well later on this morning. The NATO summit, 9 a.m., the President of the United States in a news conference.
With a very different tone than 4 years ago, or I should say 8 years ago, when he was in the room with people who really disliked him. Now you've got people who are saying thank you for pushing us to spend. A real question here about how much this actually brings allies together and how much this is just a changed world. I was struck by one of the leaders, Alexander Stubb of Finland, who came out and said, this is a new world order where you have to be more transactional and Western dominance is over. So this is the type of rhetoric coming out of the NATO meeting right now.
Annmarie's on the ground at the NATO summit. We'll catch up with her in about 15 minutes' time. Need to focus on the data as well. Tomorrow, jobless claims. Day 2 for the chairman later on this morning. On day 1, no real daylight between what he said last week and what he said yesterday. But people believe the door might be slightly open for a move in July.
So there might be no daylight between what he said on Wednesday and what he said yesterday. And yet what you look at in terms of the odds of a Fed rate cut in September went from about 60% on Wednesday after that Fed conference to about 84% today. In terms of an almost near certainty about a September rate cut, the odds of a July rate cut have gone up. But it seems like there is a coalescing, aside from 2 members of the Federal Reserve, around the idea that they need a number of more data prints before they feel the comfort of actually cutting rates.
They need one data point. It's July 9th. It's July 9th because that's a self-imposed deadline for the trade story. And then again in August with China, because they've all but acknowledged at this point that if April 2nd didn't happen, they'd be cutting rates already.
Yeah, he said the effects of tariffs will depend, among other things, on their ultimate level. I mean, this is for Jerome Powell yesterday in his testimony, essentially saying we are dependent on exactly what that level is. What if we don't get clarity? Are they saying that they don't have enough information until, say, December or October? And this is sort of the question. At what point do you have enough information to take a look at the disinflation that the market is sort of sniffing out and say, all right, we got to reflect this?
Some people think they've got it already. We've talked about the various economists who believe that. Greg Daco of EY was just on the programme, pointing to a labour market that he does not believe is sufficiently strong enough to worry about second-round inflation effects. So why bother worrying about the inflation effect of tariffs that we might or might not get? Focus on one thing, look at the labour market. Does it warrant a reduction or not? Given the disinflationary trend we've already witnessed.
You know, there are a number of people, and I would say an increasing number of people coalescing around this. It is predicated on the idea of a de-escalation theory. The idea that President Trump will be inclined to de-escalate on all fronts. We saw, for example, oil prices surge in the heels of what was going on in the Middle East. De-escalation, disinflation. Do we see a de-escalation with some of the tariff discussion that also leads to that less inflationary environment? And this really is, I think, sort of the debate between markets and what the Fed is seeing as possible.
We'll continue to have that debate on this program. Equity futures at the moment on the S&P, marginally positive, but just about unchanged. Coming up on the program, we'll catch up with Steve Auth of Federated as a risk-on mood grips markets. John Lieber of Eurasia Group on disputing reports on damage in Iran, and the former Chief of Staff to Vice President Mike Pence, Marc Short, on Trump's tax bill. We begin this hour with stock steady after hitting fresh all-time highs. The Nasdaq notching its first record close since February. Stephen Auth of Federated staying bullish long-term, writing, while you are peering out your window at the present violent storm passing overhead, try to look a little beyond it, or better, look to the end of the rainbow. Steve joins us now for more. Steve, good morning.
Morning.
I love that. Good morning. You know, with rainbow and sunshine. Walk me through it. What's hopeful about this moment for you?
Yeah, look, the news cycle is all over the place. But let's just look out 6 months or even 12 months from now where we're going to be. The tariff discussions are going to be behind us. We think we're roughly going to be at 10% on a 30% of the U.S. economy, with half of that being paid by the exporters. So very little impact. The tax bill is going to be passed, probably by July 4th. the deregulation effects on increased investment by U.S. companies because higher after-tax returns on investment are going to be in place. Economy is going to be growing pretty quickly as a result. All the uncertainty that's been holding people back in the first half of the year here is going to be off the table. Companies are going to be able to invest. AI is going to really be starting to work in terms of productivity, which is softening up the labor market. And, inflation is going to be running 2 to 2.5%. The Fed is sitting here at 4%. So we're 150 basis points at least above where they're going to land. So we've got 6 cuts in front of us. I don't know if it starts in July or September. I don't really care. It's going lower. That's pretty equity market friendly. We've got earnings at 340 out in 27. We think the multiple on the market should be about 22 because half the market is in big cash flow generating asset-light companies, which is different than people's heuristics on what the market should trade at. So you add it all up and we're heading higher. That's kind of where we are.
Let's unpack some pieces of that. The first piece, the trade piece. I think you said something like half of it's going to be paid for by the exporters. So this is important. By definition, of course, and we repeat this all the time, so allow me to go through it all. The importer pays the tax, they pay the tariff, but how the cost is shared is the real debate. Exporter, importer, does it go through margins? Does the consumer have to take on it? All of it. What gives you the confidence that half of it's going to be paid for by the exporter?
Well, historically, that's been the case. When we did it the last time around in Trump 1.0, that's kind of what we saw. And it kind of depends on the exporters, but certainly on exporters, sending cheap cotton T-shirts and sneakers to us, they have very little power in the agreement. So they end up having to eat some of it. And some of it just gets eaten up by productivity gains.
So why do you see inflation? Do you find that there is a contradiction between the idea that inflation is going to go back down to the Fed's target, already is there, or close to it, at the same time that the labor market remains resilient? I mean, how much room are you letting in there that there is going to be a weakening in the backdrop for labor?
So, Lisa, one of the things you said earlier this morning, I was watching the show, was this idea that the Fed could cut because they can cut as opposed to they need to cut. I think you're on to something there, right? And this is what we've been saying, that if the inflation numbers come down, the Fed can cut. We've never seen them cutting because the economy is weakening substantially. But the more resistant they've been, and we call them data resistant, the more they're causing the economy to soften up. So at some point, they're going to get pushed into cutting. We don't see a recession anywhere near us here, but the labor market is softening up. So they're going to have to cut.
Well, it raises a really good point. And yesterday, people were saying that the reason why people were pricing in a greater degree of rate cuts was because of disinflation, not because of necessarily weakening in the underlying economy.
Yeah.
What's the threshold where the Fed has to cut by a certain time, or else you have to start worrying about a hard landing, a further deterioration of the U.S. economy?
Oh, goodness gracious. I mean, if they don't cut by the end of the year, I think But this Fed, look, they're not that data resistant. But by September, once we get the tariff discussions behind us, they'll have very little excuse not to cut. And the inflation numbers are going to be very soft. We're already running around 2.5%. So they're way above the inflation rate. I don't know. I'd find it stunning if they don't start cutting by September, honestly.
So let's talk about the rainbows. You said that you have your target for the end of this year, 6,500, and potentially 7,000 for 2026. Not only is that realistic, but potentially undershooting the potential of this market. It might not be bullish enough. How much does this fly in the face of some of the U.S. exceptionalism discussions? I'll get it out of my mouth.
It's the heat.
What?
It's the 35-degree heat.
Oh,
triple digits. It
honestly,
does it to you.
It's warm out there.
I will just tell you, yesterday, I don't know about you. I know you like warmth. That was another level.
I love the heat, but I was in the heat
God.
for a little while, and then I came downstairs and I sat on the PC and forgot the password.
So if I mispronounce something,
Mrs. Ferro in the
stay hydrated, John,
and ask her for the password to the
stay
PC.
hydrated.
I so relate to that, but I just wonder, how much you buy into the idea that this is going to be the U.S. Really instead of everybody else, or whether this is everybody benefiting from a really constructive backdrop.
We think the whole market looks pretty good, actually. actually overweight emerging markets. I saw you had my friend Jay Pelosky on earlier this morning, and I agree with him on that. I'm not so as optimistic about Europe, and they've got a lot of defense spending to do, which is going to cut back social spending, and we're going to be the beneficiaries of some of that because we're the major manufacturers of defense equipment. So, I see the U.S. as continuing to lead us here. We've got the big companies that are leading this bull, which is AI-related, technology-related. But the worst world is coming along, and it's a lot cheaper, especially emerging markets. And if you look at the world and you say to yourself, who else has got tech besides the U.S., it's actually China. So, they're a big piece of the emerging market index, and you can buy those stocks a lot cheaper than here. So we like EM here.
One quick question. There is one point of tension, I think, between you and Jay. You believe the exporters will pay the tariffs, which is another way of saying you believe they're going to have to take a hit on margins. Now, I'm not sure if that's Jay's view of the world. How can you be overweight or even like international equities if you believe they're going to have to burden a lot of the tariffs?
Yeah, I think that's a fair point. I don't think they're going to bear all the tariff, Jonathan. I think some of it. And, there's a lot of companies overseas that are not necessarily exporters into the U.S. Those aren't necessarily the companies that we would be buying here.
That's fair.
Yeah.
Stick to Chinese tech.
Chinese tech looks pretty interesting to us.
How interesting? Was it the DeepSeek revelations of earlier this year, or is there something else going on there?
I think that was a tremor in the market there. But we've been, we were long, we went overweight EM back in November. So we were a little bit early, frankly. So it was before DeepSeek, for what it's worth. We weren't predicting DeepSeek, but that probably helps us on that call.
Steve, appreciate your time.
Thank you, Jonathan.
Just bullish and right all the time at the moment.
At the moment, Jonathan.
At the moment? OK. I'm not trying to jinx this for you, OK? Just trying to give you credit. Stephen Auth there of Federated. Some people believe still, April 2nd, all these things going on, that the DeepSeek revelation at the start of the year is still the biggest story of 25.
Yeah, and there have been other stories about how there are many deep seeks out there that are coming to the fore. I just want to set the record straight for those of you who live in the United States. 35 degrees is responding to Celsius
I said triple digits as well, didn't I?
Yes, but in Fahrenheit, we think about 101. And the humidity, which it felt like 115.
OK.
Yeah, he said it, but I'm
got
just
a transatlantic audience.
Yeah.
Bit for everyone.
I'm just, putting it,
Thanks,
the numbers.
Brad.
It's hot anytime.
It's hot. Confirmation of that, all right? Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. President Trump expressed support for NATO as he arrives at the summit earlier this morning. Trump telling Secretary General Marc the U.S. is, quote, with them all the way. NATO is set to formalize plans to increase defense spending to 5% of GDP, a major change that President Trump has been pushing for. Meanwhile, Fed Chair Jay Powell continues his testimony on Capitol Hill later this morning. This after he reiterated yesterday he's in no rush to cut interest rates. He did say that if inflation pressures remain contained, the Fed may cut rates sooner rather than later, but he did not take the bait, refusing to point to a particular meeting. And a surprise here in New York, Zohran Mamdani is poised to win the Democratic nomination for New York City's mayoral race. This after a commanding win in the first round of voting. The New York State Assemblyman is running on a progressive platform amplified by social media and policies, including vowing to freeze rents and making buses free. His rival, former Governor Andrew Cuomo, has conceded. That's your Bloomberg brief. John?
Yahara, thank you. What's the trade here? Get long realtors in Westchester County? Is that the trade?
I'm not sure. I think that the trade is, see what happens. Social media. I would say invest in social media stocks because honestly, the social media spending really highlights the new for political advertising.
Super diplomatic.
Thank
that was
you.
smart. That's good. All right. Up next, conflicting reports.
Mr. President, what's your reaction to the intelligence reports saying that the Iranian nuclear sites were only partially devastated?
We hear it was obliteration. It was a virtual obliteration.
Up next on the programme, we'll catch up with Annmarie on the ground of the NATO summit, and we'll speak to John Lieber of the Eurasia Group, live from New York City this morning. Good morning. Live from New York City, good morning to you. Equities at the moment just about unchanged on the S&P 500, positive on the Nasdaq, adding some weight to the rally and the all-time high at the close in yesterday's session on the Nasdaq 100. The focus shifting to Europe and the NATO summit under surveillance this morning, conflicting reports.
Mr. President, what's your reaction to the intelligence reports saying that the Iranian nuclear sites were only partially devastated?
They don't know. I mean, they did a report. We hear it was obliteration. It was a virtual obliteration. When you take a look at the ground above, don't forget the flame is all underground. But everything above, if you look at the before and the after picture, everything above is burned black.
Here's the latest this morning. President Donald Trump disputing reports claiming the airstrikes he ordered on Iran had only a limited impact on its nuclear program. Joining us now from the NATO summit is Annmarie. And Annmarie, I think the administration this morning stressing that this is an initial assessment. It will take time to get a more comprehensive one.
That's what we heard from the Defense Secretary Pete Hegseth, who was sitting with the president as he started this bilateral meeting with the Secretary General Marc when you heard him speak there. This is preliminary, and in the intelligence world, when something is preliminary, usually there's low confidence. We also should remind our viewers that the Defense Intelligence Agency, where this report came of, is just one of more than a dozen intelligence agencies. And individuals I've been speaking to will talk about the fact that this was high-level machinery and weaponry that was dropped on these 3 nuclear facilities. And the fact of the matter is, for a precise report on the damage, there's going to need a lot of reporting on the ground, and that is going to take a lot of time in terms of the data. We also heard from the IAEA, the chief, Rafael Grossi, who's been on our program before as well, who before the U.S. strikes was even concerned that they were unaware of where the 400 kilograms of 60% enriched uranium in Isfahan was at that moment, said that the significant damage is done, but questioned whether or not this is going to be putting Iran's nuclear program back months or years, but then stressed that his inspectors need to be there on the ground. So this is what I would call a preliminary report. It is very fresh, and there just needs to be a lot of time and data that we have to wait to figure out exactly precisely what components were hit and how far back this does put the Iranian regime from making a nuclear weapon.
It looks and sounds like you might need to take shelter from the wind, Annmarie. We'll catch up with you in the next hour. Bloomberg's Annmarie with the latest at the NATO summit. Number one question, and you've raised it a few times, and Annmarie has as well over the past few days, and I think we have to keep bringing this up, and hopefully they do in news conferences when the president speaks again later this morning. Do we know where the highly enriched uranium is? That's got to be a number one question every time we sit down with the president.
Yeah, and how urgent do they think it is to try to assess that, right? I mean, if they really are potentially weeks away from enriching it further or deploying it in some kind of way, is there some sort of active discussion for reigniting some sort of oversight program?
Joining us now to discuss, John Lieber of the Eurasia Group. John, welcome to the programme, sir. Before we get sort of knee-deep with what's happening over in Europe, I think we want to talk about the president's agenda and the key deadlines still to come. July 4th, the self-imposed deadline for the tax bill. July 9th, this self-imposed deadline for a trade deal with a whole host of countries. John, where do you think we'll be by the time we get to the middle of July?
You know, this tax deal is coming together and they're basically done with it. There's a couple of kind of dotted I's and crossed T's they've got to think about right now. And of course, there's the House of Representatives, who isn't going to like the deal that's coming out of the Senate necessarily, but I think is going to have a really hard time voting against this thing. You're going to have unanimity among the conservatives in the Senate to pass a bill with deep cuts to Medicaid, the most impactful cuts that they've done on an entitlement program in decades. And I think that some of the moderate members are probably where you're going to have a harder time getting the votes because of the issue with the SALT cap, which is the Senate's moved back down to $10,000. The House had passed it at $40,000. That's going to be an issue you have to work out. But with President Trump now out there truthing that nobody should go home for the 4th of July holiday until this is passed. If it doesn't pass next week, it's going to pass shortly thereafter. On the tariffs, that 90-day pause is up on July 9th, and a lot of countries, there's a lot of countries are still negotiating their deals. So I think it's notable that despite the really early momentum around Japan, India, the UK, of course, announced something, you haven't finalized anything. So they're going to have to extend this 90-day deadline and they're probably going to do it for most of the biggest countries. But I also think they're going to send a message here by increasing tariffs on some countries. Maybe not back to Liberation Day levels. Trump still has total discretion here as to what level he's going to get to. But some of these tariffs are going up, and only Trump knows which ones that is. The White House staff doesn't know, and I think they probably haven't made that determination and won't for at least a week or two.
John, this president doesn't stop. By the looks of things, he never sleeps. After the next few weeks, what's left of his agenda? What does he focus on?
I think that it's going to be crisis response, right? So, I mean, this is going to look a lot like the first Trump term, where they did the tax, they tried and failed on healthcare in the first half of the year. And then the second half of his first year was all tax reform. And then in year two, it was kind of just, Trump tweeting about all kinds of subjects that was whatever was on his mind and responding to what was going on in the world. And then, of course, picking a trade battle with China. He's already picked the trade battles. He's going to be done with his tax agenda. There's going to be foreign policy crises that come up from time to time, like we just saw in Iran this week, but he's not actively pushing much. And on the deregulation front, I hear a lot of people talking about the tailwind coming from deregulation in the latter half of Trump's term coming up, but that stuff takes time. And they're going to stop enforcement across a number of, for example, financial regulations, basically. But deregulation itself is a whole process. And if they want it to stick up in the court, they have to do it right. And doing it right means going slow. And it means you won't see the results from the deregulation, if there is any, until possibly the end of Trump's term or even after, when all of that, of course, could be reversed potentially by a Democrat.
John, there's a lot to unpack there. I want to talk about crisis response, in particular to foreign policy. It seems like people are taking the recent developments in the Middle East as providing something of a roadmap for how President Trump will respond to future international crises. What's your take on that? What did we learn from the way the president handled Iran and the attacks by Israel?
Yeah, I think what we learned, and this has been a pattern throughout Trump's time, is that foreign policy is pretty easy for him when there's a power imbalance. When there's a power imbalance and the U.S. can respond with overwhelming force and has no risk, really, of being struck back at, Trump will strike. He did it in Iran twice now with the assassination of Soleimani and now this unprecedented level of bombing. But if you look, for example, at Russia, where there's less of a power imbalance, they have nuclear arms already. There's nothing really Trump can do to intervene in that conflict. So I think this is going to be something that other countries are paying attention to. I'm sure China is paying attention to what happened in Iran this week. Now, China's diplomacy and their ambitions have a much longer time frame, and they're much less of an active threat to their neighbors than Iran was. So that situation is obviously very different, of course. But I do think that I think that Trump is willing to act. He's not going to commit American troops on the ground. I think that's a red line for him. But he is willing to throw American firepower at countries that are irritating him if he thinks he's going to win without consequences.
This is kind of a curveball, but you talk about, we learned something about President Trump's response based on the mayoral primary election in New York. What have we learned about the Democratic response to President Trump's policies, if anything? Has that sort of served as something of a roadmap? Yeah, I don't think so, no. I mean, New York City, great, most important city in the country, but it is not representative of the rest of America. And I don't think that a socialist mayor in New York City is going to be a look that the rest of the Democratic Party necessarily wants to embrace for the midterm elections. I expect the party's going to try to run from him. However, there is going to be a backlash against President Trump that is going to have a very left wing in its flavor, and that is going to be a national story. And you're going to have this battle inside the Democratic Party for who's most likely to win in general elections. The socialists emerging from the primary is not going to win in Missouri, but they can win in New York City. That's not really a roadmap for the rest of the party.
Hey, John, I appreciate your thoughts as always. John Lieber there of the Eurasia Group. Appreciate that response as well. You can win the primary with these kind of characteristics. Can you win a general on the national stage? Much, much harder. That's why I think the general election for the mayoral race in New York City will actually be very interesting, because the demographics have shifted and a number of people did vote for President Trump in the last election. Up next on the program, we'll catch up with the former Chief of Staff to Vice President Mike Pence, Marc Short, on Trump's tax bill. Live from New York City, you're watching Bloomberg TV. 2 days of gains on the S&P 500 following 3 days of losses this morning, just about unchanged. Very close, within 1% of record highs on a benchmark stateside. On the Nasdaq 100 at those levels already after the close yesterday, and up another 0.2% this morning. With 2 hours until the opening bell, let's get you some morning movers and cross over to Danny Berger for more. Hey, Danny.
Hey, John. Starting with a tech company, and let's be honest, a blast from the past. BlackBerry, you love it for making those phones. Now it is just a software company reporting really strong earnings yesterday, upgrading its revenue outlook, saying that specifically demand for its cybersecurity software has been really strong, which means this uncertain business cycle, it's been able to really stay above it because of concerns about things like hacking and cybercrime. Those shares up about 7% in the pre-market. To the downside, we heard from General Mills moments ago reporting their earnings. Shares are down nearly 2%. They had a very weak forecast, looking at losses as much as 15% for their earnings per share for this year, given a constant currency. Really a concern that in the grocery stores, consumers are pulling back on name brand items. They also noted weakening margins because of higher input costs. Now, along the same lines, FedEx also had really weak earnings after the bell yesterday. Its forecast going forward for profit, that missed expectations. It also declined to give a full year outlook, saying that it can't predict what is going to happen from here. The CEO noting the sharp fall off in shipments between the U.S. and China, which is their most profitable route. That really hurting, sending shares lower by 5% this morning, John.
Danny, thanks for the update. More from Danny in about 60 minutes from now. On our radar this morning, our top story, President Donald Trump arriving at the NATO summit, expressing support as the group bolsters defense spending.
With this 5%, the Europeans and the Canadians will equalize their defense spending with the United States.
We will be equalized very shortly, and that's the way it has to be. It's going to be a lot of money, too, a lot of defense.
Trillions extra.
Yeah, and we have a great relationship. And we've really worked on this subject for a long time.
The President Donald Trump alongside the NATO Secretary General Marc Rutte there. Marc Rutte, and the round trip that we've seen from the alliance he now represents in the last 8 years, started by this president back in 2017.
At the time, it was considered hugely adversarial and something that was really problematic for a lot of the NATO members. Now, the members, the almost 36 of them, come together and say, look, Russia and China are existential threats, and we need to raise our defense spending to 5%, except for Spain, and we'll get into Spain, I'm sure, at another time. I will just say, I wonder how much the sort of kumbaya feeling extends to some of the trade negotiations that also are kind of looming out there.
I think we can sort of put a line between them both.
I think so. I think that's probably fair.
But I would say they're also connected in one particular way, that this president has pushed this continent, Europe, to do things that are good for them. And he's pushed them because he's tested the alliance, questioned the alliance, and made them think they need to fend for themselves. And that's what's pushed them to come around, that and the threat next door coming from Russia, to start spending more on defense.
Yeah, the circumstance has changed on a large level. I will say that Finnish President Alexander Stubb, what he said about how that we got intellectually lazy in the past few years, and that, frankly, Western dominance is over, and that you need to understand a world that is more transactional and more multipolar, highlights how there has been a sea change in terms of this alliance.
You know what? I don't know if that sums it up enough. I think it was sort of European establishment, elitist nonsense to look down their nose at anyone that was questioning them. That's why they were in the position they were in. And now they've been forced to recognize they need to change. I think they thought they weren't intellectually lazy. I think they thought they were intellectually superior to some of the criticism they were getting from elsewhere. And it's only 8 years later, from the president's first term, that have had to wake up and realize that ultimately he was right on a whole bunch of things.
There's a lot that needs to be reconciled, and certainly it seems like there has been a reconsideration there. I won't weigh in on all of that. You said it beautifully. Invest in social media stocks.
You'll come back for everything this morning. We'll get back to that story later. All right. You want to talk about trade? The EU planning retaliatory tariffs on the US if President Trump implements a baseline levy on the bloc. EU officials also expecting the US will keep some tariffs in place even after negotiations are completed.
So can we really say that it's priced in? I'm just still thinking about what Jay Pelosky said, that all of the tariffs and the potential retaliation is priced in, and that we can look past that. That really isn't going to be part of what's going on. I'm not sure that that's true, because maybe we understand what President Trump wants to go after. But as the European Union raised, I don't think we understand the retaliation or how angry some of the trading partners still are.
You've mentioned this before, July 4th connected to July 9th. What happens with a tax bill might inform what happens with the trade deals?
Yeah, if there is no deal passed by July 4th, does that push off July 9th? what actually gets passed on July 4th? How does that affect what needs to get paid for by July 9th? I mean, there are a whole host of different connections, but these two dates are intimately intertwined, and it does seem like one could affect or push back the other.
Danny mentioned one of the big movers in the pre-market, FedEx. FedEx forecasting worse than expected profit for the current quarter, expecting softer demand and citing a, quote, uncertain global demand environment. The carrier's US-China shipments falling significantly in May. The stock's falling as well this morning by more than 5%.
Yeah, and saying that Chinese U.S. shipments are expected to remain low. FedEx used to be a bellwether of the economy. It's kind of shifted as it focuses on cutting costs, but it highlights how difficult it is for some of these companies that are really at the epicenter of trade disputes for them to gather exactly what the volume is going to be and what the reaction is going to be. And it highlights the uncertainty, frankly, in global trade flows and economic activity.
The stock is down and down hard this morning. Let's turn back to Capitol Hill. The Treasury Secretary, Scott Bessent, saying House and Senate Republicans can cut a deal on SALT within the next 2 days, believing senators can begin voting on the bill by Friday. President Donald Trump writing, "No one goes on vacation until it's done." The former Chief of Staff to Vice President Mike Pence, Marc Short, joins us now for more. Marc, good morning. Good to see you, as always. Thanks for being here. Thank you for being here. You were a big part of passing the president's first tax bill in his first term. How different is this effort? How much harder is it this time?
I actually don't think it's harder, because I think the prospect of having a $2.5 trillion tax increase for a lot of Americans, or $2,100 per family, is a big enough threat that it keeps Republicans united. So there's going to be a lot of noise over the next several days. There'll be a lot of noise on the Medicaid provisions. There'll be noise on SALT. But I think ultimately there'll be sufficient votes in the House and the Senate to get it done. Can we get to the noise on SALT? And I'd love your personal opinion on this. What you think they should do that they aren't doing right now? Well, I think from a policy perspective, the SALT provisions are terrible. I think the reality is that you have middle America subsidizing blue states that are poorly run. And they have enormous deficits, and so they provide enormous deductions because their taxes are so high. It provides no incentive for them to actually fix their own problems if their wealthiest taxpayers are able to have enormous deductions. Having said that, what I think is actually going to happen is I think that with the standard deduction now at $30,000, the priority for those who want the SALT deduction is to get it to $40,000, but they'll lower the income threshold. Now, how many people have income under $400,000 that are taking deductions of over $40,000? I think is probably a pretty small number, but the realtor base, actually the lobby base, is more concerned about getting the deduction back, because one of the provisions that we passed in 2017, prior to that, there were 31% of taxpayers itemized. Today, it's down to 9 or 10%. And the real estate industry wants that back. And so I think you're going to see them fight for the $40,000, but lower the income threshold.
I will just say New York does contribute about 8% of the GDP to the overall United States of America, and it doesn't get the same amount back. So there is this argument being made by a lot of representatives in New York that actually the U.S. is, that a number of blue states have been cheated by U.S. spending. Sure. So, I mean, that is sort of a backdrop here, just to recognize that.
I think, Lisa, there's just argument you go on a per capita basis, sure, but I think it's hard to argue that New York and federal cities aren't getting their fair share of federal dollars.
Just taking a step back and beyond the SALT debate, which I'm sure could be, we don't want to get to New York.
Social media spending.
No, social media spending. I'm telling you, just definitely invest in it and hone those strategies. But I am curious about, just going forward, how important it is to get those offsets and how attenuated some of the Republican Congress members are to offsetting any kind of increase in the deficit. If it's not from potential cuts, then from increasing tariffs.
Well, okay, so those are two big different questions. I'm a little bit cynical on this, I confess to you. The reality is that neither party is addressing what's driving the deficit and the debt. Neither party is willing to address entitlement spending. So you're going to hear people who pound their chest and say, we're fiscal conservatives and we need more cuts here. But we're really talking about pennies on the margin of the size of this bill and the size of where our debt is today. So if they were really serious about wanting to cut the debt, they'd actually be addressing entitlements. And so, yeah, I think you'll see some posturing from some people. But ultimately, again, I think they're going to fall in line, because it's not just the fact you have an enormous tax increase on working families. There's also significant border funding in this. And if you tell me that there are going to be members from border states who are Republicans who are going to oppose this bill with President Trump in the White House, I just don't see it happening. Now, on the tariffs, look, the reality is you talk about the significant revenue coming in. I think that, again, that's a tax on the American people. That's where the revenue is coming. It's not coming from foreign governments. It's coming from American importers. And the reality is you're 100% right on the dates of this, that, we were anticipating from Peter Navarro 90 deals in 90 days. We see where that's gone so far. And I think they wanted to push the July 9 date because they're hoping they get this all wrapped up by July 4th. If it slides past July 4th, I think you'll see that date slide as well. But you're going to continue to see, I think the president wants to leverage to be able to use the tariffs however he wants, whenever he wants, which provides enormous uncertainty in the economy.
The president of the NATO summit today, I'd love to turn to foreign policy with you. What did you think of the strikes over the weekend and the current posture of this administration?
I think it was exactly the right call, and I think that it's actually pretty consistent with where he was in the first administration. If you recall the maximum pressure campaign and the strike on Soleimani, I think what is different is that I think the first administration had a pretty united foreign policy. I think there's much more divergence in the second administration on what that foreign policy was.
Within the White House?
I think so. I think within the White House, too, not just with outside.
What do you think the biggest difference is at the moment within the White House?
Well, I think that there's a lot of people who have embraced sort of the isolationism of the party today. And I think they are represented. Their voices are represented in the White House. But I think the president made the right decision. And I think that, I think moving forward, Iran wants ceasefire because it buys them more time. I mean, how many ceasefires have Iran and Hamas agreed to since the Iranian Revolution 46 years ago? So I think it's important the United States stand with Israel.
And this is going to sound somewhat contradictory, but to be successfully isolationist, do you have to be interventionist sometime? Do you have to demonstrate that to do nothing, you have to be willing to do something now and again?
Well, that assumes that those who are articulating isolationist views today are actually consistent in their viewpoints. I think that in many cases there are plenty of grifters that have surrounded the president. And so they were isolationists in this moment. They were interventionists 8, 9, 10 years ago. So I think the premise of your question implies there's actually consistency on those articulating that view today, and I don't think there is.
Just pairing this with NATO, do we have a sense of what the final word's going to be with Russia and Russia-Ukraine, given the willingness to use intervention in Iran? Is there a discussion around that and support for that in the case of Russia?
I think that's one of the biggest, starkest differences between the first administration and the second administration. In the first administration, President Trump, would be very proud about having sent Javelin missiles and talked and ridiculed that Obama only sent blankets to Ukraine. There was plenty of, I think, deterrence against Russia that it seems this time around that is not that same position. And so I'm not sure that what happened in the Middle East and Iran actually applies to what's going to happen in Ukraine and Russia. It seems that this administration is not as supportive of Ukraine as the first Trump administration.
Marc, what do you think changed?
I think that there's several things that changed. I do think that there's a different personnel in the White House. I think that from where it was as far as the State Department, the national security staff, and frankly, the vice president. I think those are big personnel changes that differ in this foreign policy views.
Marc Short, appreciate your time. As always,
good
to see you. Thanks for being here. Really good to see you. If you are just joining us, welcome to the programme. Tracking equities for you. Equities just about unchanged on the S&P 500. With an update on stories elsewhere this morning with your Bloomberg brief, let's cross over to Yahira Arnott for more. Hey, Yahira.
Hi, John. Sources tell us here at Bloomberg that Chinese President Xi Jinping will miss the BRICS Leaders Summit in Rio de Janeiro next month. The country citing a scheduling conflict as the reason for Xi's absence. This will mark the first time the Chinese leader has skipped the summit since taking power. Meanwhile, pro basketball is under new leadership. The NBA's Timberwolves and WNBA's Lynx have been purchased by a group of investors led by entrepreneur Marc and former baseball star Alex Rodriguez. The group also includes Michael Bloomberg, the majority owner of Bloomberg LP, which is the parent company of Bloomberg TV. The sale is valued at $1.5 billion. And in a mission carried out by SpaceX and Axiom Space, a crew of astronauts from 4 nations were sent to the International Space Station. SpaceX's Falcon 9 rocket lifted off at about 2:30 a.m. local time from NASA's Kennedy Space Center in Florida. It's the first time astronauts from India, Poland, and Hungary will go to the ISS. The launch had been delayed several times due to various issues. That's your Bloomberg brief. John?
Yahira, thank you. Does that mean we get free tickets?
To space?
Mike's involvement in sports.
Yeah. Oh, yeah.
Do we get more free tickets?
No, that doesn't.
I say more. I haven't had any yet.
I was going to say, what are you
If anyone out there's
first?
listening. All right. Up
Is
next.
there anybody out there?
Someone. Up next. Already. Too late.
Previously, you said that if you wait for inflation to get back down to 2% to cut rates, you are already too late. What is the reason not to cut rates?
Well, it's uncertainty about the size and potential persistence of the potential but highly uncertain inflation from tariffs.
Up next on the programme, we'll continue the conversation on the Federal Reserve with Tina Adatia of Goldman Sachs Asset Management, live from New York. This is Bloomberg. Coming into Wednesday, close to all-time highs on the S&P, at those levels right now on the Nasdaq, and adding just a touch of weight to the rally, up another 0.25% on the Nasdaq 100, up a tenth on the S&P, following 2 days of gains. In the bond market, the focus at the front end of the curve, the 2-year, just starting to give way. Yields lower over the past few sessions, just about unchanged this morning. The 2-year at 379.30, with the focus on the next move from the Federal Reserve. Under surveillance this morning, already too late.
Previously, you said that if you wait for inflation to get back down to 2% to cut rates, you are already too late. What is the reason not to cut rates?
Well, it's uncertainty about the size and potential persistence of the potential but highly uncertain inflation from tariffs.
Here's the latest this morning. Fed Chair Jay Powell facing a grilling on Capitol Hill as he sticks to script and holds off from signaling imminent rate cuts. Tina Adatia of Goldman Sachs Asset Management writing, growth risks have receded, but our base case is for a soft second half of the year. Tina joins us now for more. Tina, welcome to the programme. I'm going to pick up on the Congressman's question. Are they already too late?
Look, I think your question is a good one. I think if you think about kind of what we learned yesterday from the testimony, was really first and foremost that the Fed is in wait and see mode. They're still kind of data dependent. And the reason for that is what he kind of already said, which is if you think about that second point around inflation, on inflation, if he sort of says, OK, well, I need to start cutting rates, the reality is you have an environment where tariffs are going from an effective rate of 2% to a rate which is kind of closer to 14%. We know from previous trade wars that it takes a few months for tariffs to kind of pass through. On top of that, you have this situation this time where there's been a lot of tariff uncertainty, right? So you haven't necessarily seen the pass through on prices as quickly as you might have hoped. So Powell saying that he's going to wait for the summer months to kind of see what the pass-through effect is on inflation. Their base case is for transient, but it may also not be. And so they kind of have to watch that. I think that's the first point of why they don't want to cut rates. The second point, I think, which we learned this time, but also from their previous announcements after the FOMC meeting, was that they're much more focused on the labor market. And I think if you start to see labor market weakening, then for sure you will see the Fed act. So if you think about it, what have we seen so far? Labor markets have been pretty robust. You've had reasonable payrolls. Unemployment rate has stayed in line. What you would expect, though, is if the unemployment gets closer to sort of 4.5, then probably they're more likely to move faster. What you're seeing in those second round effects on labor markets right now is that some of those revisions of labor markets are looking a little like downtrending. So that's, I think, something that will be much more of a focus for them to cut rates as opposed to just inflation.
Tina, there's a big question in markets right now, and you can kind of feel it on the FOMC as well. Is there a window for the Fed to cut for the right reasons? And I put right in quotes with this idea that it comes on the heels of disinflation without the threat of really a reignition of some sort of rapid price increase from the labor market. Is that window now versus do they have to see the weakness that the market was worried about for the Fed to cut for the wrong reasons, which is to prevent further deterioration?
I think the reality is that's kind of where we were a few months ago, where pre-Liberation Day, you had that environment where the Fed was able to do kind of more of that proactive cuts before weakness. I think where you are now is those risks have become a little bit more balanced, number one. So the inflation risks are not completely well understood, and I think the Fed wants to learn from those risks. And also on growth has actually held up reasonably well. So whereas kind of at the beginning of the year, there was kind of an environment where people had started worrying about kind of growth. That's not necessarily the case. So if you look at kind of corporate balance sheets, they've held up pretty well. Consumption has held up well. Yes, some of those softer indicators are looking like they're trending down. But I think it's just much harder for the Fed to make the case when they haven't necessarily seen at least a little bit more weakness, and also to ensure that that inflation animal, which is less understood because of this exogenous tariff shocks, is not well understood. So you kind of have to see that before the Fed is able to kind of cut rates more proactively. I think the point around the window is a more interesting one, which is that does that window to cut rates narrow because in 2026 you start seeing some of those fiscal measures that make it much more difficult to then cut rates. So I do think that there is a narrow window, but it's quite difficult for the Fed to balance that environment between those higher looming potential inflation risks, which is still maybe not as well understood and something that has to be watched, but also the fact that labour market weakness hasn't really come through and actually looks pretty solid and robust.
Tina, if the Fed were to cut next month with the long end, would yields rise?
Oh, look, I think what we think is that you are going to continue to see an element of curve steepening, and you've already seen quite a lot of curve steepening, particularly at the long end globally, for a variety of reasons, mostly down to obviously the fiscal and also potentially some inflation, although not really, because forward-looking inflation expectations in the medium term look kind of okay. I think probably we're going to continue to see a reasonable amount of term premium. We have curve steepeners on in our US position, and we will keep those on. Whether they will actually rise at the long end, I think, is a little bit more nuanced. And the reason for that is obviously if the Fed does cut rate, then obviously the debt service starts coming down. The other thing that you see, and you will continue to see, is generally, debt management around kind of where issuance happens kind of globally.
Tina, do you see that in Germany as well? Just to jump in, when they issue more debt, are they doing it at the front end in the same way that the United States is, or is there a different base there of demand that they can take advantage of, similar to what we see in, say, the UK with much longer average maturities?
Well, that has changed a little bit in Europe, actually, and it's changed for a few reasons. It's changed partly because, of course, you've had in Germany that announcement around the fiscal, which has caused steepening. But interestingly, of course, the curve still is not as steep in Germany as it is in other parts of the world. And I think your point points to insurers and pension funds. On the pension fund side, I think it's a little bit more nuanced. You've had things like Dutch pension fund reform, where there might have been that environment to buy the long end of that curve is maybe less there. On the insurance side, I think that demand kind of remains. So they've seen steepening of the yield curve still, not to the same degree as maybe you have seen in the US or Japan. In Japan, of course, is the extreme of that market. But across the board, you've seen steepening of the yield curve just in recognition of fiscal deficits rising.
Yep. Tina, technical but important. It's good to hear from you. Thanks for being here. Tina Adatia there of Goldman Sachs Asset Management on steeper curves. This morning, a little bit steeper as well. The long end yield higher by a single basis point in the Treasury market. The 30-year about 4.84. Up next on the programme, Alicia Levine of BNY Wealth, Sheila Kahyaoglu of Jefferies, Claudio Irigoyen of Bank of America, and Matt Hornbach of Morgan Stanley. The third hour of Bloomberg Surveillance is just around the corner. A focus on day two with Chairman Powell on Capital One in front of the Senate Banking Committee this time after going in front of the House Financial Service Committee yesterday. No daylight, little daylight between what the chairman said last week at the Federal Reserve News Conference and what we heard just yesterday from New York City. This is Bloomberg.
Even though equities are very expensive, there's more liquidity in the system today than there was pre-pandemic.
This market is just pushing you into risk, and it's been really hard to resist that momentum.
You need to be risk off to be back to risk on.
It's looking pretty bullish right now. You still have to be careful.
The market will respond when the circumstances change, for the better or for the worse.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance starts right now with equity futures near session highs and about another 0.2% on the S&P. Your scores look like this on the Nasdaq 100 coming into Wednesday at all-time highs and up another 1/3%. Later on this morning, 2 times to look for. 9 a.m. Eastern time, about an hour from now, you'll hear from the President of the United States, scheduled to hold a news conference at the NATO summit in the Netherlands. Then later, an hour later, day 2 on Capitol Hill, for the Chairman of the Federal Reserve, Jay Powell, at 10 a.m. Eastern time, going in front of the Senate Banking Committee.
With one of the key questions being how much data do they need before they can cut rates, given the fact that we have seen a disinflationary trend in the data. How much are we depending on jobless claims continuing to roll over? And this is why I think actually tomorrow the jobless claims is going to have a renewed focus, especially given the Conference Board consumer indicator yesterday that showed that people are getting a lot less confident about their ability to get work.
Jobs just aren't as plentiful. We saw that in the data point just yesterday. Jobless claims roundabout near the highest levels of the year so far, which has made some people just a touch nervous about the position this labour market is into going into the summer.
So it goes to this question of data over dependence, as Steve Auth was talking about from Federated. Is this Fed looking backwards and saying, look, we don't know enough to extrapolate out into the future? Is it entirely because of tariffs? And do they get that clarity on July 9th that they need to really move forward? Or is this dependent on something else, the reaction function, if you will, of companies and consumers about what they're willing to absorb and how much strength there is in the underlying economy?
Steve Auth made a couple of points. First one is he doesn't believe they're data dependent. He believes they're data resistant at the Federal Reserve. His point on tariffs was interesting. So by definition, and we say this all the time on the programme, the importer pays the tariff, but how the costs are shared is up for debate. He believes that half of the costs are going to be burdened by the exporter, and that's going to be someone else's problem potentially. Which is somewhat controversial because some people say that it's not going to really bear that it will have a greater impact on either company margins or inflation. Even Marc Short, the former legislative director for President Trump, saying that it would be borne by the consumer. This is the question. Is there too much complacency in the market right now around the tariff negotiations, especially at a time where the European Union right now is raising the prospect of retaliatory tariffs? This is going to be an ongoing question as we hit the 1-2 punch of July 4th and July 9th. 2 key dates coming up over the next few weeks into that all-time highs on the Nasdaq 100 and very close on the S&P 500. Coming up this hour, we'll catch up with Alicia Levine of BNY Wealth with tech stocks at record highs. Sheila Kahyaoglu of Jefferies with defense spending in focus. Annmarie will join us from the NATO summit in about 10 minutes' time. Plus, we'll catch up with Matt Hornbach of Morgan Stanley on underpriced risks in the bond market. We begin this hour with tech stocks back at all-time highs. Alicia Levine of BNY Wealth writing, the pain trade is higher as the market shrugs off lingering tail risks. We still expect a slower economy given the tariff shock and lingering uncertainty. Alicia joins us now for more. Alicia, good morning.
Good morning.
Just reconcile those two things for us. Help us understand it. The equity market continues to do well. At the same time, the economy continues to soften.
So I think we've seen the slowing, right? All the data points you're talking about in the labor market, we've had 3 weeks in a row where new claims data are above 240. The expectations for it to slowly creep higher. So you're seeing some softness already. I think in the recent CPI, you also saw some softness, not just in the services for housing, but also for discretionary spend on travel. So you're starting to see a little bit of demand destruction for some discretionary spend. At the same time, we do have these dates in front of us. I think for the most part, with everybody focused on what was going on in the Middle East, the tariff story went to sleep. It was overload. It was flooding the zone. And so there are some risks in there. I just would say this. I think the market has been remarkably resilient in pushing through this. And you could say that the 20% decline in March and April really reflected all the risks that are out there, and in some ways it was already priced in. So I would expect some consolidation here, but I don't think you're getting a major sell-off here. And with that, the market's moving higher. I mean, it's showing you, if I gave you the fact pattern of what happened in the last 2 weeks in the Middle East, right? And the highest we got on WTI was 78 for a second. And now, just the market was not pricing in anything devastating to growth or inflation or to oil prices. Seeing this is essentially contained, which is amazing.
Let's sit on the price of the market, and I agree with you, it's absolutely amazing, phenomenal. We've got this elevated forward multiple, and I've heard from guest after guest who said that reduces our capacity to absorb shocks. And what do we do repeatedly? Absorb shocks. And I'm just wondering how much of a constraint that elevated forward multiple actually is.
So, we're back to the multiple we were in, at the end of December, early January. But the multiple on most of the tech stocks is actually lower. And what it suggests actually is that earnings are actually going higher for 2026, because we're at that time of the year where investors are focused on 2026 earnings. Whatever happens with 25, it's in the rearview mirror. It's a cinch backward looking, even for the third and fourth quarter here. That's where you'll get some volatility. But market's looking at 2026, and I would suggest that the earnings are probably going higher because the multiple's hanging in there.
If your head's spinning, join the club. And if you're trying to understand how much you could take the flood of information and actually process it through markets in any way, shape, or form, it really raises the question, should we just shut it off and look at ChatGPT and how it's being applied across companies and how much we can invest in those companies?
So this is a great question. I actually gave a talk yesterday to a bunch of folks who are implementing AI in all of their businesses. We had a big conference on it. And I gave a macro markets talk. And people said, wow, you cut right through it. And the reason I say that is that we are bombarded by news, whether it's inflation or Jay Powell in front of Congress or consumer sentiment, where it's just these negative data points everywhere. But the fact of the matter is that the market's looking through it. That is also a signal. The market is forward looking. So you have to shut it down. You have to look at what you go back to, which is earnings. And the 50% of the S&P are implementing AI at an extraordinary rate, which is going to drive the margins higher for the overall index. We're talking about information technology, consumer comm services, and financials, right? These are the sectors that are really, there's an arms race in who can implement faster. That's productivity, and that's margin growth. And that means that the trade that we've still had of increasing margins in the growth areas of the S&P will continue, which means you can go higher.
Does this just divorce the link between the economy and the stock market all the more? Where you could see a labor market that continues to weaken based on the fact that productivity is going up and the workers who are there are doing more and better work. And potentially there are fewer employment options, particularly for new entrants to the market. But profit margins keep surging at a select number of small of large companies.
So that is the disconnect. But we always talk about how the S&P is not the economy, but over time it is. So as your GDP grows, your nominal earnings go higher as well. They are linked over time, not in specific points of time. So it's a subtle difference, but it's true. But you're right. I think that's where we get the disconnect. That's maybe where we get some volatility in the market, when we get those lower jobs numbers. When we get sort of job growth under 100,000, that's not going to be so great for the market. But again, I think what you're seeing is that young workers, the unemployment rate there is actually 6.5% in the 18 to 24-year-old. And I see it. I see it out there. That's really what to keep your eye on. The new job growth doesn't seem to be there, and we know that the Magnificent Seven are not hiring, and in fact, they're having, rifts. So that's really where to look. I think the white-collar jobs seems to be stalling out, and that's your productivity. It is a disconnect. I don't think the market's going to absorb that. Those numbers, those labor force numbers, whether it's new claims on Thursday mornings or whether it's the Friday BLS numbers, that will have some effect on the markets as well.
We've been having this conversation for at least 12 months now.
Yeah.
And we've been in this holding position for at least a year. Any reason it can't continue?
So it can't continue if growth goes below 1%, right? If GDP is 1%, you will have dislocation in markets. That is really where it is. I think we've been looking at the labor market as a tell. So far, it looks like it's hanging in there. But you can still grow under 100,000 jobs a month and actually be in equilibrium with the supply of labor, right? So we're used to these numbers. If you go back to the beginning of 2024, the average job creation monthly was 155,000. Now, we also know that gig workers are not included in that number because the economy is growing in an interesting way, in a different way that the official numbers are not really picking up. So at 139,000 jobs in the last jobs report, you're sort of in that 155 average number for the last year and a half. That's still there. Even if you go below 100,000, you're still in equilibrium with the supply. If there's an equilibrium in supply, it can continue.
Torsten Slok of Apollo, what did he say yesterday? 50K.
Yeah.
Maybe get used to 50,000 a month, never mind 150.
Yeah, and where those lack of jobs are, the fact that it is people who are entering the workforce. I mean, talk about a lost generation. I'm not to get all political here, but there's this question of how do you deal with a time of transition where the technology is transforming the way that we think about jobs so quickly in order not to have an entire generation that doesn't get jobs for a number of years out of college.
If you just joined the program and haven't been following, every time we get to the edge of being political, Lisa just turns around and says, invest in social media stocks.
So I think we're getting close. Well,
invest in social media stocks.
I think that you need to look at social media.
All right, that's super helpful. Let's finish on tech leadership. Maybe that's a good place to finish this conversation. We've questioned tech leadership in this country repeatedly.
Not all of us.
Not you.
Not all of us.
Why are you sticking with it?
Oh, because it's clear. This is where the growth is, and this is where the margin growth is, right? There's a concern about overspend. There was a concern that the CapEx spend was going to crush free cash flow, and that's actually been the leading indicator of where these stocks go. That it has somewhat, but I think what's been made clear, and you saw in the first quarter, that they're just powering through. That's really the story there, right? The story really is, can you get increasing margin growth out of these companies? The answer so far is yes. They grew at 34%, right? So in the first quarter, as long as the growth is there, the market is fine, as we know. But I'd say also, as the diffusion of AI goes, you're getting higher margins everywhere throughout all the sectors, and specifically 50% of the S&P. So tech, comm services, and financials.
Alicia, it's good to see you. As always, thanks for dropping by. Alicia Levine there of BNY Wealth. The headline just crossing for you. NATO allies agreeing on a new defence spending target of 5% of GDP. It will be marked as a big win for the President of the United States, who's at that NATO summit right now. Annmarie's over there in the Netherlands. We'll catch up with AMH in about 5 minutes' time. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Arnott. Hey, Yahara.
Hi, John. President Trump says he expects to discuss Ukraine with President Zelensky at a meeting later today as both leaders attend the NATO summit in The Hague. Trump also saying he has been speaking a lot with Russian President Vladimir Putin. He said to reporters that he told Putin he doesn't need help on Iran. Instead, quote, I need help with you. Meanwhile, Zohran Mamdani is poised to win the Democratic nomination for New York City's mayoral race. This after a commanding win in the first round of voting. The New York State Assemblyman is running on a progressive platform amplified by social media, as Lisa has said, and policies like vowing to freeze rents and making buses free. His rival, former Governor Andrew Cuomo, has conceded the race. Meanwhile, a check on shares of FedEx. They are down 4.8% in the pre-market after the delivery company warned its profit will be worse than expected this quarter due to pressure by U.S. tariffs. And although it typically provides a full-year forecast, FedEx said it would only share its outlook for the current quarter due to uncertainty over global demand. That's your Bloomberg brief. John?
Yahara, thank you. Thank you very much. More from Yahara in about 30 minutes' time. Up next on the programme, the Morning Calls Plus, Sheila, Kahyaoglu of Jefferies, as these two headlines cross from the NATO summit in the Netherlands. NATO allies agreeing on new defence spending. The target is now 5% of GDP. The leaders reaffirming their commitment to the collective defence clause. That conversation is just around the corner with Sheila and Annmarie on the ground at the summit. Live from New York, this is Bloomberg. The opening bell is 1 hour and 14 minutes away. Stocks are higher by 0.1% on the S&P. On the Nasdaq, up by 1/3, adding to the record high that we closed out in yesterday's session on the Nasdaq 100. That's the price action. Here are some morning calls for you. First up, Loop Capital raising its price target on Nvidia to a street high 250, saying it's well positioned for the next golden wave of Gen AI adoption. Your second call from Wells Fargo raising its price target on Microsoft to 585, saying its AI business could reach 100 billion in revenue by 29. And finally, Citi cutting its price target on FedEx to 259, pointing to weak guidance due to the impact of tariffs. That name is down by almost 5% in the pre-market. That's some of the stories, some of the morning calls. Let's turn back to one of the biggest issues globally. Just moments ago, NATO allies agreeing to a defence spending target of 5% of GDP. With reaction to the headlines, Annmarie at the summit in the Netherlands. Good morning, Annmarie.
Good morning, John. It's quite an ambitious goal, and Marc Rutte, the Secretary General, has been talking about the fact that he thinks the alliance was going to be able to get this over the finish line. 5% in terms of GDP spending needs to go to defense now if you are part of this alliance. There's some nuance this that we should talk about. Right now, when it comes to core defense that each member state should be spending, it's at 2%. So they are increasing this for core military spending. Think of ammunition, tanks, all the artillery. That will go to 3.5%. The remainder 1.5% is part of the industries that potentially could support the industrial complex. Maybe some funds can go to things like cybersecurity or border patrol. So that's where that 5% comes into play. And they have a decade to do it. This is going to 2035. So some countries that potentially have been naysayers when it comes to this, like Spain, Marc Rutte is saying, well, they're going to have to spend a lot more in the course of the next 10 years. So this is a big feat for him. And obviously, this is a massive win for President Trump, who Marco Rubio, the Secretary of State, told Politico heading into the summit that this is really Trump's summit. This individual, the President of the United States, has been talking about the fact that he doesn't think NATO spends enough for decades. And now they have a very, very ambitious target ahead of them. And that means trillions of dollars of spending, especially from the likes of a lot of these European countries.
Annmarie, spending on what and what for? What are they going to do about Russia? And are they going to get the president now to put even more pressure on Vladimir Putin?
Well, that's a big question for a lot of these individuals, especially Volodymyr Zelensky, who is here and who will be meeting with the president on the sidelines. The president said that he actually had a call with Russia's President Putin regarding Iran. And Putin said, can I be helpful when it comes to Tehran? And the president says, actually, you could be helpful when it comes to Russia. That is a huge foreign policy goal for this president, to bring a ceasefire and an end of Russia's invasion of Ukraine. And for countries in Europe, and this is in the document, and it is also in the Financial Times piece that you had the Chancellor of Germany, Friedrich Merz, and Emmanuel Macron talk about, they say they have a threat right here on the continent. This war is still waging on the European continent. And that is why when you hear from the German Chancellor, he says everyone wants to say we were pushed by Trump, which they definitely were pushed by Trump when you ask Marc Rutte, the Secretary General. But he says we have our own collective experience of this war. And that is why we need that defense spending. And that is why they are lifting when it comes to the core military spending of ammunition, tanks on the ground. They are lifting that from 2 to 3.5%. But of course, this isn't going to be done overnight. They are getting a decade-long time frame to get that defense spending up.
Annmarie, thank you. More from Annmarie later on this hour as we count down to an important news conference with the president about 40 minutes from now. Annmarie mentioned Marc Rutte, the Secretary General of NATO. For too long, one ally, the United States, carried too much of the burden of that commitment, and that changes today. The president, you made this change possible. The words of Marc Rutte earlier this morning.
With a policy overlay that really expedited the urgency of the matter, which was Russia and the invasion of Ukraine. But this is a complete about-face versus 8-9 years ago, where the NATO meeting sounded very different than it currently does.
Huge change, that's for sure. Let's stick with defense. Sheila Kahyaoglu of Jefferies writing U.S. operations against Iran likely put further emphasis on the fiscal year defense budget. Joining us now is Sheila. Sheila, good to see you.
Good seeing you.
Defense spending very much in focus, given this headline as well coming out of the NATO summit. Companies like Rheinmetall, German defense operator, that stock is already up 177% so far this year. How much of this story is already well priced?
Well, we focus on the U.S. names, as you know, Jonathan.
Of course.
And in terms of what we're seeing is we were at the Paris Air Show last week. It's historically a commercial aerospace show, but a lot of focus on defense exposure. European defense companies are trading at 50 times EBITDA. These multiples are ridiculous. And we're seeing a lot of focus from U.S. investors into European names, but also undiscovered names, whether it's a name like AeroVironment that reported last night. Elbit in our coverage, it's an Israeli name, 30% Israel exposure, 20% U.S. exposure, 25% Europe. So who has hidden European exposure that could benefit from some of the NATO spending, which is going to pour hundreds of billions into additional defense spending?
Do we have a sense of which region of defense contractors Europe will be working with disproportionately? Will it be mostly European defense manufacturers? Will it be the United States? Will it be elsewhere? Does it matter? Is this being used as a diplomatic tool, or is this just where they can get them in order to get their forces up?
Historically, it's been 2/3 of European spending has been flowed back to the U.S. But companies like Rheinmetall are really emerging, investing in their local capacity. In the last month, we've met with all 5 defense contractors, And the common theme is local for local. Yes, we have a facility in Spain. We have a facility in Poland. So we think about 50% of the NATO spend will come back to the U.S. And I actually think over the next 5 years, it'll be focused on missiles, munitions, replenishing what got lost in Ukraine. And over the long term, I think what we'll lose out on is the fighter aircraft. You know, the local teams, France, Saab, will have local manufacturing of larger equipment in Europe. And U.S. will still supply missiles, air defense, which is where the U.S. really excels at.
Yeah, to build on that, there was this feeling, and John, you mentioned it, it was like watching Top Gun in action over the past couple of weeks in terms of the B-2 bombers and what they actually engaged with, and how much is that, you know, different countries around the world saying, I want that, versus just the very nuts and bolts of, you know, I need another missile here, I need another thing there. I mean, is that kind of the sort of more humdrum aspect of what we're actually talking about here from the European build-out?
Yeah, I think we have to give the Northrop B-2 bomber a minute here, because I think it's so amazing. And it just happened this weekend, and everybody brushed it off on Monday morning. The last time it was used was against Yemen in 2024. But aside from that, it was used in Libya in 2017 and 2011 before that. So we don't use these that often. I went to the facility in Palmdale where Northrop sustains them. I mean, the coating itself costs hundreds of millions to recoat every time. So it's a pretty cool aircraft. We only have 20 of them. We used 7 over the weekend. So I think it also helps accelerate the Trump agenda, whether it's the next generation fighter with NGAD, which they awarded to Boeing, and pulling forward things like the B-21, which is also a Northrop aircraft.
What about what we have seen take place in Ukraine, in the war between Ukraine and Russia, and their ability to cause serious damage to air defense of the Russians with just drones? That seems to be a major development over the last couple of years. The character of war has changed. And I wonder if the type of investments, the kind of things that people invest in defense, is changing too.
I think a little bit of both. The reconciliation bill, which is about $150 billion, has $9 billion dedicated to drones and other autonomous vehicles. So the Trump agenda really focuses on accelerating technology and what the next war will look like, whether it's against China, but it also pushes forward their agenda. One of the things I do really appreciate is how the bill really pulls forward programs that are already accelerating, whether it's like Textron's FLRAA program. If we have it, if it's in the air, why are we waiting for certain milestones to be reached?
Sheila, important conversation. Good to see you, as always. Thank you. Sheila Kahyaoglu there of Jefferies on defence spending. On the headline that just crossed just moments ago, now targeting 5% of GDP, when not so long ago you'd struggle to get countries to spend 2%. The new target's 5%.
And now you have the German parliament actually signing off on some $200 billion or billion euros of spend over the next number of years. Where this is going to be spent, and to your point, John, how much this has already been priced in, is really going to be the question.
Things are changing, and they're changing fast. Up next on the programme, we'll talk about the economy. Claudio Irigoyen of Bank of America with a focus on the next move from the Federal Reserve and why some people think July might be in play, and others who have wrote to me this morning. In a 24-hour news cycle, Bloomberg journalists hint at rate cut that is not coming in attempt to talk about something. So we'll do that next on the programme.
That's correct. Well, what do you suggest?
Pretty harsh words this morning.
You know,
right.
I will just tell them, please, we're open. The suggestion box is open. What would you like to talk about?
From New York City, good morning.
Social media scouts.
Stocks are positive, up another 0.15% on the S&P 500. On the Nasdaq 100, all-time highs in yesterday's session. We add some weight to that move this morning. On the Nasdaq 100, up by 1/3 of 1%. Let's get you some morning movers. Let's cross back over to Danny Berger, who has more. Good morning, Danny.
Hey, John, got some earnings to work through, and there has been some notable weakness, especially in ones facing consumers. FedEx, for example, reporting after the bell yesterday. Their outlook for the current quarter, missed expectations when it comes to profitability. Also declined to give a full-year outlook, too, something FedEx usually does. This time around, the CEO saying that it's too unclear the outlook from here, so they are unable to do so. Shares falling more than 5%, especially with a steep drop-off in U.S. and China shipments. We also heard from General Mills, another one of these companies, saying that the uncertain environment means that consumers are pulling back. They called it the value-seeking consumer. Shares down 3.9%. They see EPS for the year falling as much as 15% with a constant currency. That is more than expected. Also noting that just consumer tastes have changed. No one wants to buy their sugary cereal material anymore, apparently. Finally, rounding things up with a little bit of Southside action, Stellantis getting an upgrade from Jefferies, saying that they see a positive turnaround with this new CEO. They're refreshing their lineup. They're fixing stocking issues. So those shares up 4%, John.
Danny, thank you. Cereal, very expensive.
Yeah.
Bramo, you noticed that?
Well, especially if it's on one of the shelves that you see immediately because they pay for that shelf space.
So they need to get the money back.
And you really want to look at the up shelf or the down shelf because that's where you get the better deals.
You know what call it, right?
What, I know you
cattle feed for humans.
I know.
Yes.
You know, honestly,
That's what I call
you
it.
didn't grow up in
It's
Lucky Charms. I think
terrible
it's embrace your inner child.
I think my mum came back with Lucky Charms once and put it on the kitchen table.
My grandma.
And never again.
Yeah, well, in my household, we would have cornflakes and my father would just pour sugar over it. So it was a different household.
Same thing, basically.
Yeah. Pretty much. All right,
Got
let's
there
move
in
on.
the same way.
Social media stocks.
Fed Chair Jay Powell. Let's do that instead. Heading back to Capitol Hill for day 2 of his testimony to lawmakers. Bloomberg's Michael McKee joins us now for more. Hey, Mike, are we expecting anything different later on this morning?
Actually, we might get a little something different, John. Not from the chairman. He's likely to give us pretty much the same arguments he gave yesterday to the House about why the Fed is on hold. The Fed is basically managing tariff risks, is his argument at this point. Inflation and unemployment are likely to rise, so the Fed is better off waiting to make sure they know what's going to happen to the economy. And with the economy solid, they can wait. The rate cuts that they had talked about are still likely to happen this year, Powell told the House, but he wouldn't put a time frame on it, even though there's been some talk of July from a couple members of the Fed. The new news today may be made by Senator Tim Scott. He's the chairman of the Banking Committee, and he and some of his colleagues sent a letter to Powell last night saying that they are going to be asking him about a couple of important things. The Fed's plan to renovate its buildings. In the letter, Scott said, at the same time Americans are struggling to put food on the table, the Federal Reserve has been spending billions of dollars on the renovation of 2 of its offices in Washington, D.C. As a matter of fact, they're spending $2.5 billion. The original budget was $1.9 billion, and that has now expanded to $2.5 billion for the Eccles building and the Fed East building. The Fed argues that these were built in the 1930s, and it takes a lot of work to bring them up to code, plus the fact that they're historical buildings, so it costs more to renovate. But the senators are saying that that is not acceptable at this point. We do not find the justification sufficient, especially considering that this lavish renovation is being done at a time when the Federal Reserve has not made a profit since 2022. So we could see a little bit of a spark there between the chairman and the chairman.
Mike McKee, thank you, sir. That's the Federal Reserve. Let's head over to the NATO summit. The President of the United States just standing by. Let's take a listen.
I know, I realized, yes. I was listening as well. Yes.
Yeah, you did a beautiful job.
Yeah, thank you, Mr. President, and thank you for being at the NATO summit. I think together we made a big achievement in NATO today. And agreeing on the 5% and making a real big step forward. Right. And now working together on defense industry and make sure that we got the deterrence and defense in the Western world, Europe, America, Canada, together, make it strong.
Thank you very much.
Thank you. Big decisions today.
Great honor.
Yes, my honor.
So thank you very much, everybody. We're going to have a press conference in a couple of minutes. So.
Thank you, Press.
How about we'll do that? We're going to do it in a couple of minutes. Some great statements just came out from the Israeli Atomic Energy Commission and from Iran, as you know, that it was complete, total destruction. And CNN turned out to be fake news, as always. That's why they have no credibility. That's why they have no viewers. But we're going to read it to you if you haven't seen it. Have you seen it, Jeff?
Yes, sir.
Have you seen it? Yes, okay. Pretty good. Very unfair to the pilots that risk their lives for our country. And then they get fake news, New York Times and CNN, make up a phony story to get some hits. That's the only reason I cared about it, because those pilots were so brave. I've never seen anything like it. They flew into the hornet's nest, and then they got hurt so badly by what the fake news wrote. And it was CNN, it was the New York Times, and they're both disgusting, really horrible groups of people. The pilots did an unbelievable job like nobody's ever seen. They hit pay dirt. You see where I guess you probably look, they call it the wound. You see where the wound is. 3 of them right next to each other. Perfect. And they should be admired and respected for what they did. And the fake news, in order to try and hit me, the fake news made them look bad, but now they look really good again. So that was the Israeli Atomic Energy Commission, and it was also about the High Commission of Iran. Just said it was totally demolished. But we're going to have a news conference in a couple of minutes, and we'll see you, because I don't want to burden the Prime Minister with this. Okay? Thank you very much, everybody. Thank you.
The President of the United States there, alongside the Dutch Prime Minister at the NATO summit in the Netherlands. There will be a news conference at the NATO summit in around about 25 minutes' time after NATO members agreed to spend 5%, or at least target 5% of GDP on defence spending. The President once again taking the opportunity to speak to the press to push back on reports of an initial assessment from the Pentagon about the damage done to those several nuclear sites in Iran hit over the weekend.
And this is the second time that he's indicated that Israel sent agents over to Iran to inspect what damage there actually was. He's now calling about the Israeli Atomic Energy Commission putting out a report saying that there was substantial damage done to the nuclear facilities. We did hear from Iran, also from the foreign ministry, saying the same. So doubling down on that, and it really does affect the road of the road to travel going forward about how these discussions with Iran do evolve.
Just getting that headline from the Israeli Commission that I think the President was attempting to cite. The US strike rendered Fordo inoperable following the strikes over the weekend.
Which has been a question, given the fact that the satellite imagery has been inconclusive to some people. Both the New York Times and CNN, a number of other media outlets citing the Pentagon putting out a preliminary report. I'm sure we'll be getting additional reports, preliminary and otherwise, in the weeks and months to come.
That statement coming from the Israeli Atomic Energy Commission. More from the President of the United States in around about 23 minutes' time. So look out for that news conference in just a moment over at the NATO summit. We need to focus on the US economy and day two of testimony from Chairman Powell on Capitol Hill. Claudio Irigoyen of Bank of America writing the following: the tariff roller coaster rumbles on as geopolitical risks re-emerge, but global growth remains resilient. With recession risk receding, we raise our growth forecast to 1.6%. Claudio joins us now for more. Claudio, good morning.
Good morning.
1.6% at the start of the year would have sounded dreadful, but on April 2nd, it would have sounded wonderful. What's changed for you?
Well, this is just to clarify. First of all, nice to see you again.
Good to see you, sir.
John. First of all, I think this is the number for the U.S. Growth forecast for the U.S., 1.6%. For global growth, we uplifted 20 basis points to 3% now. And I think what has changed is that even though we had a massive escalation on the tariff side, we also had a very swift, quick de-escalation. And since we changed the forecast about a couple of months ago, we had a significant improvement in trade negotiation dynamics. And this is one of the reasons why we think growth will be at that higher. We are not going to have such a slowdown in the third quarter. We expect the third quarter to be around 1% quarter over quarter. And the second quarter is going to be a bit higher than expected because of the payback from the aberration of the first quarter due to the massive increase in imports.
What you just said, your analysis, very, very similar to what we heard from the Federal Reserve's Michelle Bowman. Michelle Bowman also saying that the situation at the moment now is demonstrably less risky, which is why she thinks we should open the door to a rate cut as soon as July. Where are you and the team on that now?
That's a great point, because less risky doesn't mean that it's riskless. And what we think is going to happen is that you are going to see the impact of tariffs throughout the second half of the year. Because what companies are doing first, obviously, they try to front-run as much imports as they could before the impact of the tariffs. And now they're going to spread out the increase in prices because they don't want to lose market share. So you're not going to see a massive spike in inflation, but you're going to have more persistent inflation during the second half, which make the Fed's job much harder because it's going to take longer for them to see the peak in inflation. And I think that's what Powell means when he says we need to see more.
When do you think we're actually going to see this inflationary shock, given the fact that we already have had tariffs that have been on, and you haven't necessarily seen it so far in the CPI prints?
Yeah, I think you have a combination of two things. You had a disinflation trend, and now you have this additional shock. As I said before, when companies decide to spread out the increase in prices to avoid losing market share, that means that probably end of the third quarter, fourth quarter is when we're going to see the big impact. Actually, we reduced the peak on inflation measured by core PCE from 3.5% to 3.1% for the fourth quarter of this year, but we're still going to see an increase in inflation from here.
Which raises the issue of how much room there is for fiscal expansion. And that's another one of your calls, that you don't see fiscal consolidation. And certainly the discussions heading into July 4th would support that there isn't necessarily any kind of true net retrenchment in terms of fiscal spending. How much do you see that as fueling some of the better than expected growth that you now expect globally for the remainder of this year?
I think you're going to see the impact of the final budget bill towards the end of the year and at the beginning of 2026. We expect something around 6.4% overall deficit. You have 3.3 percentage point of GDP just paying interest, which is too much. And we need fiscal consolidation in the U.S. The simple issue is that 70% of the spending is mandatory in the U.S. So it's politically very, very costly to do it. Obviously, the market will respond at some point, but probably it's going to take longer for the market to see that. Remember that number includes close to a percentage point of GDP coming from tariff revenues. Those numbers might be lower. And spending might be higher. So we might end up in a situation in which the market start wondering about the sustainability of the debt again.
It feels like we've been on disaster watch for a bunch of reasons for a long, long time. And one thing that's been proven by the last few years is that we've consistently underestimated the resilience of this economy in America. What is behind that? What's the biggest pillar of that resilience? Is it the fiscal spending? What do you believe it is?
That is part of that. But let's be honest. Productivity growth in the U.S. is significantly higher than in the rest of developed economies. And just 4 or 5 months ago, people couldn't believe that productivity growth was so high relative to Europe, for instance, or Japan. So that's one important thing, which is a structure that's not going to go away. When people say we're going to take the money out of the US and put it into where? Europe? Japan? Suddenly people say, yeah, probably we're massively overloaded US assets, but once we rebalance a little bit, the US story is still the best one. And on the bond market, let's remember what Rudy Dortbush used to say. In economics, things take longer than expected to happen, but when they happen faster than expected. So it's impossible to know the timing. But I think at some point the market will test fiscal policy again.
Claudio, it's good to see you.
Great to see you too.
Thanks for being here. Thank you. Claudio Irigoyen there of Bank of America Securities. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross back over to Yahara, who has more. Hey, Yahara.
Hi, John. Iran's foreign ministry spokesperson says the country's nuclear sites were, quote, badly damaged by U.S. airstrikes. That's according to the Associated Press. The comments come after President Trump disputed a U.S. intelligence report that said the attacks didn't cripple core below-ground components of Iran's nuclear program. Meanwhile, President Donald Trump surprising oil traders and even his own officials when he announced yesterday that China can continue to purchase oil from Iran. The comments appear to undermine years of U.S. sanctions on Iran aimed at cutting the regime's main source of revenue. A White House official later clarified the sanctions remain. And Fed Chair Jay Powell continues his testimony on Capitol Hill later this morning. This after he reiterated yesterday he's in no rush to cut interest rates. He did say that if inflation pressures remain contained, the Fed may cut rates sooner rather than later, but he did not take the bait, refusing to point to a particular meeting. That's your Bloomberg brief. John?
Yahara, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead. Plus, we'll catch up with Matt Hornbach of Morgan Stanley on underpriced risks in the bond market. Live from New York, this is Bloomberg. The opening bell about 42 minutes away. Equities at the moment positive by 0.1% on the S&P 500. On the Nasdaq up by 1/3. That's just the price action of the moment. Things can change through the next couple of days. So here's the trading diary for you. Later on, the NATO summit underway at The Hague at 10 a.m. Eastern time. After we get a news conference from the president in about 12 minutes. An hour later, We'll hear from the chairman of the Federal Reserve and his testimony, this time in the Senate. On Thursday, US GDP plus another round of jobless claims. On Friday, core PCE and UMich consumer sentiment. Just minutes now from that news conference with the president at that NATO summit. Bloomberg's Ollie Crook joins us now for more. Ollie, quite a morning already. A big agreement, it seems, and a major target.
Absolutely, John. I mean, this is really sort of a historic moment. I just spoke with the president of Finland, who, of course, was not even part of the NATO alliance 2 years ago, and is now sitting around the table with these other leaders. He was not president. He was called back to run for election to become the leader of that country in order to also now represent Finland around the table. These 32 nations that have come to this massive agreement of boosting defense spending to 5%. Remember, this is the pledge that Donald Trump was really demanding of European leaders, basically saying that they'd been slacking off on their sort of commitments to NATO. And he had sort of floated that number a few months after he was elected, before he was inaugurated. And I would say, John, that 6 months ago, this was really an inconceivable thought, that you would have European countries spending 5% of their GDP going towards defense. And now it has become, as of this morning, a reality. So this is something that Donald Trump is going to claim credit for. And I think no matter who you ask, even here in Europe, no matter how many of these leaders feel about Donald Trump, it is something that he deserves credit for at this stage. We're hoping to hear from him in just a few minutes' time. The couple caveats here, John, that I think are worth pointing out is only about 3.5% of that spending will be on military hardware, guns, ammunition, tanks, that sort of thing. The other 1.5% is a little bit of a fudge that can deal with things like cybersecurity and the infrastructure to kind of move some of this military equipment across the European continent. And again, there's also the question of the deadline. The deadline is 2035, so it gives a lot of runway. And there is a little bit of concern by some of the countries on the Baltic, on the eastern side of Europe, that this could be used to basically, it's kind of delay the pricing, delay the buying. Potentially, Trump is not president anymore. They could get out of it. But overall, everybody I've spoken to, from the sort of Baltic to the other leaders across Europe, are very content with this agreement, and something that really Donald Trump has made a sort of center stage of his policy proposal, and is something that he's put through today here in The Hague.
Ollie, important clarity. Thank you, sir. Ollie Crook there at the NATO summit in the Netherlands. There's going to be a lot of spending on defence in Europe and again in the United States. What does it mean for fixed income and this bond market? Matt Hornbach of Morgan Stanley joins us now for more. Matt, welcome to the programme, sir. We're going through the mid-year outlook from yourself and the team. Let's talk about the bond market call and the dollar call with that in mind. What's the new base case for you and the team?
John, thanks for having me on the show. We see both of these assets going down. The dollar we see going down in price. We have the dollar depreciating about 10% over the next 12 to 18 months. And then for Treasury yields, we have Treasury yields also falling. We have the 10-year yield ending this year at 4%, and we have it ending closer to 3% by the end of 2026. Now, both of these forecasts, of course, are related. They are driven primarily by a Federal Reserve, which ends up cutting policy rates much more aggressively than what markets are currently pricing in. We're more confident, I would say, on the magnitude and the direction of those rate cuts as opposed to the exact timing of those cuts. As I'm sure you read in the note, we don't have the Fed cutting this year, but we have the Fed cutting a lot next year. That's an interesting feature of the outlook, but is one that's subject to change, of course.
Matt, what are the economic conditions that lead to those deep cuts in 26?
Yeah, so ultimately, the first is that we get past the hump on tariffs, right? Tariffs create a temporary inflationary impact. Our economists have that impact concentrated in the third quarter of this year. And then by the time we get to the fourth quarter, those tariff effects are starting to fade away, and you begin to see the weakness in the labor market really come through. That's ultimately what catalyzes that discussion on the Fed to begin lowering rates, which our economics team has happening in the first quarter of next year.
Why aren't you worried, Matt, that when the Fed does lower rates, it won't cause the long end yield to rise, akin to what we saw last year?
Yeah, well, I think what happened last year, Lisa, is the Fed did cut rates and interest rates did go down temporarily. But then we went into the U.S. election, and the market, being forward looking, began to speculate on what was to come after the election. And of course, at that time, investors were thinking about much larger deficits, more government bond supply, kind of a better economic outlook than we think exists at the moment. So it was a different time, and we're not expecting that to happen again, at least for another 3.5 years.
Matt, given the discussions heading into July 4th and then July 9th, it does seem like the deficit's going to deepen in the United States. Why is that not a threat to your call to go into duration, to buy those 10-year bonds that maybe other people are steering clear of?
Well, the expectations for the deficit have actually changed quite a lot. And the primary driver of that change is, of course, tariffs. Coming into this year, most investors didn't expect the Trump administration to do as much with tariffs as they have done. And so when we think about what kind of revenue are these tariffs going to generate, and don't ask us, you can ask the Congressional Budget Office what it thinks about the revenues generated by the tariffs that are currently in place today. And the CBO scored that tariff revenue around $2.5 trillion over 10 years. Presumably, some of that's front loaded. So we are seeing a meaningful increase in revenue that was not expected coming into the year. That's going to mean that deficit expectations are actually lower than where they were right around the time of the election last November.
Matt, have you got a window in that office? Got an external window, some daylight?
I do have some daylight.
Good.
But really my daylight comes from the picture of my daughter behind me.
Oh, that's beautiful. Matt Hornbach of Morgan Stanley. Matt, thank you. That's touching, isn't it?
Did you set him up for that?
That's beautiful.
You were like, okay, your daughter's going to be listening.
I was about to say Ted Pick should give him an upgrade and give him a better office with a window.
Well, he has one. But then he had to go to his
one.
family. He has a window into the love of his family.
Isn't that touching?
It is touching.
It's a beautiful thing. It's a reminder that none of this matters. Just that.
Yeah.
Family.
Except that, and then you have the rest of the day to go ahead and, do business.
Like this, coming up tomorrow. Stacked program. Scott Cronin of Citi, Jim Zelter of Apollo, the San Francisco Fed President Mary Daly, and Russell Brownback of BlackRock. Mary Daly is the interesting one there. Out of all of those, we love the rest, but of course, Mary on the Federal Reserve, given day 2 of Chairman Powell, is coming right up.
Yeah, how much dissent is there actually on the FOMC, or is there some sort of coalescing around the idea of what data they are watching and what the path of travel is going forward? Can they cut for the right reasons disinflation without the weakness in the economy?
And how much is getting done in the meantime? The so-called macro paralysis that Zelter talked about a few months ago. We'll get an update from Jim tomorrow morning too. From New York, that's enough of us. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.